Rates right now are coming down. The only question is when, and I do believe that it's going to be pushed out further.
We are pushing back against the market's pricing swift, immediate rate cuts starting in the first quarter.
There is this very substantial disinflationary process in place. It's just a question of whether or not you get an uptick over the next several months.
A higher volatility backdrop, both in terms of the macro conditions, including inflation, and the market, I think should be part of the assumption.
People still worry about inflation, and there's just not a lot of data to support the idea that there is any.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance alongside Lisa Abramowicz, together with Annmarie Hordern. I'm Jonathan Ferro. Your equity market on a 6-day winning streak on the S&P 500, extending the longest winning streak of the year so far, heading towards 3 consecutive weeks of gains on the S&P 500 this morning, slightly softer by 0.2%. The good news keeps coming. Secretary Yellen says inflation is well under control. Stock markets are at all-time highs, and the hope of the White House is this can continue.
We can get to the White House in 1 second, but the markets are embracing, as Bob Michael calls it of JP Morgan, economic nirvana, because essentially you're getting your disinflation and you're getting your growth. Here's your cake, eat it too. And basically the market is embracing that, even when we get certain disappointments in earnings that sort of create idiosyncratic ruffles, everybody else moves on.
Can we get to the White House now?
Go ahead.
Let's do that. Better story to tell for President Biden and Secretary Yellen. Will it continue?
Yeah, absolutely a better story to tell. The idea that potentially we can have a soft landing is something the White House is really going to lean into. But look at the polls on my screen right now. Real Clear Politics, all of them. Economist YouGov, President Biden job approval, -6 on the spread. Harvard Harris, -20 on their spread. ABC News Ipsos, -25. Has the message yet to resonate with the American voters?
You've asked the right question. Is the calendar on their side this year? 2 guests to look out for. We'll catch up with the Treasury Department a little bit later on this morning. We'll talk to Mohammed Al-Arian in 2 hours' time as well. His message is pretty clear. He thinks they've got to do a better job at explaining this economy and explain the exceptionalism, the US exceptionalism in the global economy right now. Europe's struggling. China is struggling as well. The US is kind of out there on its own doing okay.
The story has been a little bit hard to tell, given that 2-year year-over-year comp or 2-year-over-year comp has been really inflationary, right? Have they got enough time where people are kind of settling into a better economic environment? That's the reason why it hasn't been resonating, right? How clearly can they tell a story that's somewhat complicated and very much still under discussion by many in the market as well?
So that's the economics and the financial markets as well. We'll talk about credit spreads a little bit later. I want to talk about a single name before we run away from the market too quickly. Intel. Intel's having a really difficult time at the pre-market. We're down about 11% in early trading. Decent results. They were okay. Just overshadowed by a really poor outlook. Wells Fargo, Lisa, calling it soft guidance. Truist saying the guide was well below consensus. We're down 11%.
So Intel is an interesting one because they've got to compete with the likes of NVIDIA. They're talking about personal computing. They're competing with all of the other suppliers to the cloud and other kind of in vogue technology. What I find interesting, we got 2 misses on companies that are tech sort of considered, right? We had that from Tesla, and now we have this from Intel. At what point do idiosyncratic stories become a trend, or have we gotten to a new phase where idiosyncratic remains idiosyncratic, and people just look at the specific company? It's an Intel problem, not a broader tech problem.
We'll get to Intel a little bit later. Let's turn to the broader financial markets for you. Equity futures on the S&P 500 shaping up as follows. On the S&P, we look a little something like this, negative by 0.16%, going against the grain of the last 6 days, 6-day winning streak. Yields lower by a single basis point, 4.1066 Bramo on a 10-year. The Federal Reserve just around the corner.
Yeah, ECB Christine Lagarde pulled to Jay Powell yesterday. She had an opportunity to push back against the market. She didn't, and I think that that's what you're seeing currently in the bond space, where people are saying, all right, so the Fed's basically going to cut rates. The ECB is not far behind, with now 50 basis points of rate cuts priced in that region in June.
The Federal Reserve, not too far away. I can't wait for your review of the Fed, never mind the ECB, given how you talked about President Lagarde going into that news conference yesterday.
Was I wrong?
You were right.
Okay.
And you know you were right anyway, which is why we're so excited for your review of Chairman Powell just ahead of that decision.
It'll be more exciting.
Next Wednesday. More excited?
Maybe.
Than you were about Lagarde?
Yeah, I think so.
Okay.
I think it'll be good.
Coming up this hour, plenty of excitement over the next 60 minutes on this programme. Cameron Dawson of New Edge Wealth on the 6-day winning streak for US stocks. Bloomberg's Ed Ludlow on Intel's warning for chip makers. And Greg Valier of AGF Investments on President Biden ramping up his campaign for the November election. We begin with our top story. A 6-day winning streak for stocks. Cameron Dawson, CIO of New Edge Wealth, warning of a stronger economy. Doesn't guarantee better earnings. earnings. You would hope that a stronger economy would translate to stronger earnings, but this didn't happen in 2023. GDP was much stronger than expected, but EPS estimates didn't budge. Cameron Dawson joins us now for more. Morning, Cameron.
Good morning.
Let's go straight there. The difference that you see between what stock prices are doing and where EPS revisions are going.
There has been a very interesting divergence brewing over the last 4 months, which is that you have seen multiples expand significantly, now at 20.1 times forward, and yet that entire time you've slowly seen eating away EPS estimates for 24 and 25. 2024 estimates are down about 0.5%. That's not enough to be a big warning sign to be concerned about, but you would hope that given all this soft landing nirvana, that you would start to see a little bit of uplift in EPS estimates. I think the reason you're not seeing it is because EPS estimates are already fairly optimistic. They were already pricing in 10% plus for this year, 11% for 2025. So you're starting from a high base, which just means that the equity market really never believed we were going to have a hard landing.
Let's go over the last year, where the EPS growth has been. Big tech, Magnificent Seven. It's not like they've just ran away like the late 1990s. This is real earnings growth in places like Nvidia and for other big names as well, Meta too. Do you expect them to do the heavy lifting again in 2024?
It's such an important point. It's kind of like, as James Carville said, it's the economy stupid, it's earnings stupid. You can explain all of the outperformance in sector leadership by looking at earnings revisions. So if you take something like growth versus value, that captures the tech versus the old economy trade. Growth estimates are up 5% over the last 6 months, but value estimates are down 3%. So what you have is this really divergent market as well under the surface, where the only sectors that have had positive earnings revisions in the last 6 months are tech and comm services. So those are the sectors that, of course, have led the market.
But there has been this feeling that maybe they've gotten too expensive, that people have brought forward all of the growth, and any growth that smaller companies may get from the same technological advancements has been completely left behind. Do you buy into any of that, or is that too kind of highfalutin and theoretical for you?
No, I think it's a really good point, which is that we have to balance the fact that the names that have outperformed so much, that are having these earnings revisions, are crowded and expensive. And eventually that will come, there will come a point where that becomes a headwind. But there's so much momentum right now, you're sort of in the let your winners ride camp. But I think we have to be very prudent to acknowledge that when something gets crowded and expensive, you're in the area for downside surprise. Look at home builders this week. I know it's not at all the same, but home builders were impervious to volatility and bad news. And then all of a sudden, it hit them where you had this big downside volatility. So I think maybe a day like that for tech could change the trend, but for now, momentum's to the upside.
I guess, what does it mean to be prudent at a time where everyone's talking about an equal risk recession and equal risk no landing, right? I mean, how do you sort of hedge that?
I think what you need to do is you need to reduce your exposure to heavily interest rate sensitive parts of the market. Because if you're taking a bet on things like low quality small caps or lower quality parts of the market, it is a leveraged play on interest rates. And so if interest rates move against you, you see all that outperformance start to unwind. Our preference is to look for companies with strong balance sheets. We still think that we're late cycle, which means you need companies that can navigate an uncertain economic environment and have the balance sheet to withstand what could be downside surprises, maybe not in 2024, but certainly possible in 25.
The White House has come out and all but certain basically said we're going to have a soft landing. You're calling it a strange landing. What makes it so strange?
What makes it strange is that we are coming out of such an extraordinary period of disruptions to data from the pandemic, as well as policy distortions. If we think about what's happening on the fiscal policy side of things, with a $1.8 trillion deficit, at the same time that the bond market, with 5.5 cuts, is effectively pricing in the largest easing cycle in a non-recessionary period in 40 years. So you're getting this double stimulus from fiscal and monetary policy, but then you have to throw in all of these things about Treasury liquidity into it. The data is going to be confusing. It's going to be dislocated. It'll definitely disagree with itself, which will make this so hard to determine what direction we're going in. So you have to keep your head on a swivel.
How are you thinking about the market leading up to November?
I think that we should be very cautious about thematic baskets. I used to cover the industrial stocks, and I remember that going into the 2016 election, everybody was very bullish on industrials because of a big infrastructure bill. What's very interesting is that industrials peaked as a sector relative to the market 2 weeks after the 2016 election, and it still have not overcome that peak. So be very aware
That's
and cautious
amazing.
about thematic baskets.
Do you think life's going to get more difficult for large multinationals, given what might be around the corner?
I think it is certainly possible. I think we're all keeping this in mind about deglobalization. Deglobalization just means that the margin uplift that you've been able to count on for the past 30 years possibly is going to have greater headwinds. If you're having to reshore capacity, that's capacity that comes at a higher marginal cost, which just raises the question of these estimates for ever higher margins in the S&P 500, which there's a record for 24 and a record for 2025 already baked into forecast. Is that attainable in a world of deglobalization?
As we get into the heart of earnings season, what are the sort of red flags that you're looking for that could really be a signal of something deeper, either in a sector or for a broader market?
For us, it's pricing power. Pricing power has been so very important to top-line growth over the last couple of years and has been the source of a lot of margin expansion. When you grow your revenues a lot, you get great incremental margins that flows through down to the bottom line. If we start to see fading pricing power, that will stand very much in contrast to the revenue top-line estimates for the S&P, which have an acceleration in revenue baked in. So watch for pricing power, watch guidance around how much pricing power companies have left.
Hey, Cameron, stick with us. Cameron Dawson there of New Edge. Bramo, I'm fascinated by what Liz Ann Sanders had to say at Charles Schwab yesterday, just on this point of maybe multinationals being challenged. The small caps started to pick up around this story of the Trump 10% tariff. That's one to watch.
If you believe in American exceptionalism, this concept that the U.S. economy can keep going without some sort of international involvement, well, why not immunize yourself from that potential risk? And, oh, yeah, these are also underpriced relative to where everything else is priced.
Are the walls going up? That's what we've got to figure out. Are we going to be supporting national champions? I'm thinking of one industry specifically. I'm thinking of the automakers more and more at the moment on that front.
Although we heard from Gary Cohn, right, he basically just shrugged it off. He was like, yeah, I'll get it. If I were there, I would just tell him not to. But here's the thing. At a certain point, you have to think the threat of it is going to create some sort of isolationist kind of policies. And we heard that at Davos, right, from a lot of people who are saying the policies haven't changed all that much. And a lot of companies have already had to reckon with an increasing kind of protectionist policy from the U.S.
More on this story a little bit later. Equity futures on the S&P 500 negative here by 0.2%. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief with Yahara Hackers. Hey, Yahara.
Hi, John. The Biden administration has frozen approvals for new licenses to export LNG. Officials say they need time to scrutinize how shipments affect the climate, the economy, and national security. The halt will likely disrupt plans for billions of dollars in projects. President Biden saying, quote, "This pause on new LNG approvals sees the climate crisis for what it is, the existential threat of our time." And China's central bank has unveiled plans for targeted stimulus meant to guide money into specific sectors. The PBOC made the move after surprising investors this week with a bigger than expected cut to its reserve requirement ratio. Economists see the central bank following up by steering credit into select areas and making a handful of trims to the amount of cash banks must hold. JP Morgan is shaking up its top ranks. CEO Jamie Dimon is moving two key executives, Jennifer Pipsack and Troy Rohrbaugh, into new roles as co-CEOs of its expanded commercial and investment bank. The switch comes halfway through Dimon's 5-year retention package, giving both executives more experience as he prepares potential successors. That's your Bloomberg brief. John?
Yahara, thank you. Up next on the program, the ECB behind us, the Fed up next.
The consensus around the table of the Governing Council was that it was premature to discuss rate cuts. And in addition to that, I typically stand by my comments.
More on that in just a moment. That's coming up next. You're watching Bloomberg Surveillance live from New York City this morning. Good morning. Live from New York City this morning. Good morning. Here's the price action. 6-day winning streak on the S&P 500. Here's the bump in the road. 0.2% negative on the S&P. We've been spoiled, Bramo, on the equity market over the last week.
Yeah, but if you look beneath the hood, it's Intel. It's dragging everything down, and otherwise everything's doing great. Honestly, this sort of Nirvana story, everyone leaning into soft landing, seems to be the theory and the feeling of the moment. Whether it can last, we've been saying this, and then I get all this pushback. Sure, you say that. Well, I mean, you have to question.
Bob Michael, JP Morgan Asset Management, management talking about economic nirvana a little bit later this morning. Under surveillance this morning, the ECB behind us, the Fed up next.
The consensus around the table of the Governing Council was that it was premature to discuss rate cuts. And in addition to that, I typically stand by my comments. We had to continue to be data dependent. So rather than being fixated on any kind of particular calendar, which would be being date dependent, we reaffirmed our data dependency.
Here's the latest this morning. Traders ramping up rate cut bets after Lagarde reaffirms that easing could start mid-year. Traders pricing a 90% chance of cutting in April. The Fed decision due out next Wednesday. Bloomberg Economics expecting officials to also hold rates steady, Lisa, but writing, quote, "We think the stage is set for a cut at the March meeting."
And that disinflation nirvana basically paving the way for them. I have to say, Christine Lagarde definitely sounded a lot like Jay Powell. She had an opportunity to push back. Everyone was waiting for her to push back. Well, not so much. Listen to this. Frederick Ducrozet of Pictet Wealth Management weighed in, saying Christine Lagarde could have pushed back more strongly against market pricing, betting on more than 2 quarter-point rate cuts by June. That she decided not to is an important signal in itself. It seems as if central bankers are not worried about an easing in financial conditions, and they're all systems go ready to cut rates in the sign of disinflation.
Would you call this passively dovish? Is that what we'd call this?
Well, that's fantastic. Yes, that's
sort
the
of
reason why I'm wearing a
markets
white jacket.
to run away with themselves a little bit more.
Yeah, basically, she's just allowing them to do it. There were dovish signs within the hood of an otherwise somewhat somnolent.
AMH was upset. You know why?
Yes.
Not a single Trump question in that news conference, which I find unbelievable. So allow me to address this. If you were in the Governing Council meeting yesterday, why? Why didn't they ask about this? I don't know.
I don't know. I think reporters probably wanted to get the nuance of her thoughts on monetary policy. Also, that survey came out, which she did address, and Christine Lagarde said, I'm irrelevant. And she's basically saying she stands by lifting up her staff. But it was a weird way of saying that when they put her leadership basically on blast. But I was surprised no reporter said, not just what do you think about Trump, we all know what she thinks about Trump, but is it inappropriate for you to weigh in on U.S. politics?
Let's get the thoughts of Elsa Linhos, the global head of FX strategy at RBC. Elsa, don't worry, I'm not going there first. We're going to be talking about ECB policy. Did that sound like an ECB that was going to cut rates anytime soon?
I mean, it's clear that they're now in the mode where they're looking for the start date. The question is how much more data they need to see before they're confident that the time is right to start. But as you said earlier, they're not pushing back on market pricing. They did push back several times last year. This meeting was different, and I think that in itself is a signal.
Christine Lagarde also didn't give any guidance as to which data was most important to really determine whether they could cut rates. Is this basically the idea that they're going to feel it out, and if the feeling feels right, they'll just do it?
And I think it's a little bit more than that, because a number of people were focusing on the wage data that will come out for Q1, and they wouldn't really have that until late April, and then some more wage data on June 6th. So, the narrative was, well, maybe they can't cut until June because they need to see all the data points. And I think she's trying to hedge herself. If the data continue to deteriorate, and we had some pretty bad PMIs yesterday, if things continue on that path, then they're allowing themselves the room to cut earlier if needed. And I think that's why she wasn't being very specific about what data they're looking at.
Also, do you think that the ECB is going to cut rates more steeply or more deeply than the Federal Reserve this year, simply because the economic outlook is that much more suppressed?
I'm not so sure. And one of the reasons I have for saying that is if you look at where the euro area is starting from, we had a pretty weak year of growth in 2023. And actually going into 24, real incomes are going to be a little bit firmer. The fact that inflation is coming down, you can either focus on the fact that real rates are going up, or you can focus on the fact that real incomes are going up. And I think the Fed's focused a little bit more on the former. The ECB seemingly has focused a bit more on the latter, and that in itself should not necessarily lead to strong growth, but at the very least support domestic demand somewhat.
We also know the ECB is monitoring geopolitical risks. The most notable for Europe is what's going on in the Red Sea. How do you assess that potential inflation to consumer goods, given the fact that it actually really hasn't even moved oil prices?
Right. And I think what was really interesting is how Christine Lagarde responded to those questions in the press conference. You know, she made a point of saying the cost of shipping goods by sea is roughly 1.5%, just north of 1.5% of the overall total cost of goods sold. So really playing down the impact that the moves we've seen so far could have. You know, again, she drew the parallels to 2020-21, but noted how different that situation was. It wasn't just freight costs, it was also the capacity at ports to unload and load. You know, it was a whole host of supply bottlenecks. That's not what we're seeing at the moment. Of course, if it continues, if it escalates, if it spills over into crude prices, then clearly it creates an inflationary risk. But she certainly didn't seem concerned based on what we've seen so far.
So help us out with foreign exchange. Push all of that through the FX market, the tension on the euro against the dollar. We closed last week close to 109. We're closing this week close to 109. So what's going to move this one?
Well, John, you know, I've been pretty bearish euro-dollar for a pretty long time now, at least 3-4 years and counting. But I think what's really interesting is how the ECB plays out against the Fed. Had you asked me a week ago, I was really actually hoping we might get a pretty hawkish ECB, and that would set up a potentially very interesting trade where rates could converge between the US and the euro area and potentially lead to some very interesting hedging flows and a lot of euro-dollar buying. Based on what we heard yesterday, that just looks a little bit harder to achieve for this year. You know, it's still a risk that I'm watching, and it's still, I think, something to keep on the agenda. But, you know, as things stand, it's hard to argue there are going to be radical differences between the Fed and the ECB. And if that's the case, then it does point to a far more range-bound euro-dollar.
That's been a story of the last few weeks. Asa, thank you. It's good to see you. Asa Linios there of RBC. Cameron Dawson, the floor is yours. Let's figure this one out together. The ECB versus the Federal Reserve, and what on earth to do with the FX market.
Yeah, well, they talk about being data dependent, but the data is so very different between Europe and what the Fed is working with here in the U.S. We think about the data this week. The Fed got a great upside surprise to fourth quarter GDP data. But then you look at what Europe got, which is that IFO business survey in Germany just showing abysmal outlooks, those weak PMIs. So it really would support a more dovish tone from the ECB because of how much weaker the data is in Europe versus the U.S. We think a lot of that has come from the diffusion of higher interest rates into the European economy because they simply have a lot more short-term interest rate exposure than what we have in the U.S., where a lot of companies able to term out their debt.
Does it make you optimistic to invest in Europe, even over the U.S., simply because they are seemingly a little bit more willing to cut and valuations are that much lower?
Yeah, being overweight Europe has been the widowmaker trade year in, year out, again and again. We just have seen consistent derating of non-U.S. stocks versus the U.S. That's partially because of sector concentration. There's so many more value-type old economy sectors within Europe. We are finding a lot of opportunity, though, to be selective within non-U.S. markets. And I think that's the key, which is that don't buy the index, buy companies that are trading at significant discounts to U.S. peers. But kind of a buying blind of Europe probably doesn't work. If you look on a relative basis, the market is still in a very distinct downtrend versus the U.S. So until that turns, it's likely a value trap.
I know you can't name the single names, but can we talk about them? Can you describe them? Are we talking about a Novo Nordisk,
they rhyme
an
with
LVMH?
Yeah.
I'm not going to do the rhyming game. I'll just name them for you. Are those the kind of names we're talking about?
It starts with an A and ends with an SML.
Something like that, you know?
Yeah. Look, yeah,
you're good at this.
Yes, yeah.
Keep going.
I picked it up. So look, I think that there are opportunities in retail, in semiconductors, within the European market, within healthcare as well. It's not about necessarily buying those old economy banks or mining companies, for example, and that's where the selectivity comes in.
Cameron, it's good to see you. Cameron
you.
Dawson of New Edge. Dealt with that one pretty well, I think. The FX market's been an absolute snooze. Lisa's been talking about this for months. Take the euro against the dollar. Last week we closed at 108.98. This morning, 108.75.
Wow.
Got to figure it out. The data there's terrible. Compared to the United States, which is still pretty resilient. And to Elsa's point, I think everyone's hoping that maybe you get some clear directional trade emerging on a euro, and it's just not happening on my screen.
I loved her frustration. Not loved her frustration, but you could feel the frustration in her voice.
Absolutely.
She said, you know, I hoped maybe we would get something from her. Instead, we just get the sort of wishy-washy. I guess they're in the same zone. And here we are with basically a range-bound hero.
Coming up on this programme, Intel plunging after delivering a disappointing forecast. That conversation is just around the corner. Live from New York City this morning, you're watching Bloomberg TV. Live from New York City, equities pulling back by 0.1% on the S&P 500. Here's a snapshot of financial markets. Equity futures negative on the Nasdaq by 0.5. There's the outperformance again on the Russell. Lisa, the small caps up by 0.55.
How much is this just an Intel story, right? Basically, that's dragging down all the tech names, and all the Russell 2000 names are thinking, okay, if you're going to start cutting rates, well, to the races. And that seems to be the feeling that we've really heard from a lot of our guests.
The Intel conversation just moments away. Here's a snapshot of bonds for you. 2-year, 10-year, 30-year yields look a little something like this in the Treasury market. Unchanged on a 10-year, 4.1143. On a 2-year, 4.30, 97. Data decent yesterday, Lisa, yet the whole curve just came in.
Well, the data was decent. It was perfect, actually. It was both better than expected growth from the fourth quarter than every analyst out there, but also greater disinflation, or the sort of disinflationary trend. You know, just to pause for 1 second, what Cameron Dawson said there was so interesting about pricing power. If companies have pricing power, that means that inflation goes back up. If they don't, well, that's good for the economy, but is that good for the companies? Because then their margins start to compress. So we always say the economy is not the market. And how much is that going to move in the opposite direction this year?
Who has the pricing power and where? Let's finish on this in the FX market, the euro. Who needs sleeping pills when you've got euro dollar? 108.74. That currency pair is positive by about 0.25% and almost totally unchanged, Lisa, on the week so far.
And it sounds like from El Salinos, this is basically what we can expect for the foreseeable future.
She was looking for downside. This is not what she wanted to see. But yeah, range-bound euro has been a story so far.
How can you really decide who's going to have the upper hand in terms of who cuts first and all of that when basically they're saying the same thing? And right now, there's nothing really changing on either side to change the narrative.
The dollar index just a little bit weaker. Under surveillance this morning, your top stories, the US pulling further ahead of China after better than expected GDP growth to round out 2023. In nominal terms, the US economy grew 6.3% compared to China's 4.6% last year. China's central bank signaling even more stimulus as growth worries continue. This includes a new credit market for certain sectors, a cut to reserve requirements, and a possible rescue package for the stock market, all in the past week. AMH, this goes to the US exceptionalism that Mohamed El-Erian is going to talk about a little bit later this morning.
Yeah, absolutely. China is still suffering from those draconian COVID-era policies, and they've yet to come out of that. It's hitting on the stock market. A lot has to do with the property slump, and it's just a complete divergence of what everyone was expecting. Everyone was expecting China to be able to ramp up, and that hasn't been able to happen.
Which is the reason why you're seeing the divergence in the stock markets. Last week, this is coming from TD Securities. China's equity inflows into China equities from foreign investors hit the highest since July 2015. Basically, they've gotten so underpriced that people are looking at this and saying, what do I have to lose? And so at this point, yes, uninvestable, yes, terrible, yes, they have unpredictability, but at a certain point, people want to pick up pennies before the bulldozer. So even if it necessarily is going to come eventually, it seems like an entry point.
When Mohamed catches up with this a little bit later and we focus on the economy, I think to his point on the United States, the fact that we're here in America relative to where Europe is and where China's going, it's kind of amazing that you haven't heard more from the White House about this. They've had several criticisms about these stimulus packages that they passed when they came into power. It's hard to believe we'd be here where we are currently relative to Europe and China without them.
100%, especially because everyone's talking about the massive cash that consumers have. A lot of the expectations in the analyst reports that I read after GDP came out is that it's going to continue. And why? Because people still have cash. Because not only do they still have savings, but now they're earning real wages that are positive. These are stories they could tell. We're not hearing it in a cohesive way. You're hearing more calls, get out there.
Yeah, and absolutely. And as we go towards the election, to your point, Jonathan, they haven't really told that story. Biden is out on the campaign trail trying to. He was in Wisconsin yesterday. In Wisconsin, Lake Superior. He was going to Minnesota to talk about a $1 billion bridge. That hard infrastructure money, that package that they got done, that remember the prior administration kept saying it's going to be infrastructure week, It's going to be infrastructure week. They actually got it done. And right now, leading up to the election, they're going to try to sell it.
Wally Adeyemo out of the Treasury is going to join us in about 2 hours' time. Look out for that conversation. Let's talk about the shake-up at JP Morgan, preparing a possible line of succession for CEO Jamie Dimon, Jennifer Piepszak and Troy Rohrbaugh moving into senior roles as co-CEOs of the Commercial and Investment Bank. Marianne Lake, who has worked alongside Piepszak, leading the Consumer and Community Bank, will get sole control of that segment. Dan Pinto will now focus on a broader role as president. Lisa, we've seen this a few times. Another shake-up. Every time you get a shake-up, we have the same conversation. Is he going? Is he going?
He's about halfway through his 5-year tenure. Dan Pinto seems to be getting a lot of the power. Is he going to have a more forward-facing kind of role? Is he looking for a role in government? I'm talking about Jamie Dimon, not necessarily Dan Pinto. These are all valid questions. I'm not going to necessarily weigh in.
This was the calls I got from some Republicans. I saw you were in Davos. Jamie Dimon comes out and says, well, Trump was right on some things. Look at NATO. Is he trying to ingratiate himself with the Trump campaign? Is he trying to maybe become Treasury Secretary? I said, I'm not sure, but potentially that's a better tax deal.
We've played this game how many times?
I know.
How many times?
Yeah, it's countless.
And I hear you. Yes, on the tax situation, if you can divest $1 billion worth of stock tax-free, I mean, it's an option you might be interested in. Let's get to LVMH. Shares look like this morning, surging, defying a slowdown in luxury goods. The company beating estimates with revenue growing 10% to round out the final quarter of 2023. The boost coming thanks to an increase in sales of handbags like Louis Vuitton and Dior. Champagne and spirit sales also coming in better than estimates. The news giving a lift to luxury peers, Kering and Moncler. The news out of the likes of Burberry in the last couple of weeks hasn't been good at all. So LVMH, a better story.
Yeah, maybe just sort of more selective in terms of the mix of products and also who they're catering to. And we've been talking about this, and you've been really great on sort of the buy now, pay later trend and how that really was good for certain sort of entry-level luxury. I think LVMH maybe has a bit more of the people with all of the wealth amassed who want to buy champagne, pop it open and celebrate.
If you're in Paris, the saying is all roads lead to Arnault. Every corner, there's either a Sephora, a Dior, Louis Vuitton. Then you also have the distillery and some of the alcohol products. They have something for everyone, also including Belmont hotels. So they're really in a category of their own when it comes to luxury space.
If you're in Paris, the Chinese in Paris, standout stat of the morning for me, fourth quarter, number of Chinese customers to its French stores was 30% below 2019. 30% below 2019. Is that ever coming back?
Well, I guess we heard from the CEO of Trip.com, and here's the question. She was saying there's the desire, but there isn't the visa situation. Is that true, or is there not necessarily as much desire because internal consumer spending in China has not been that strong? It's a decent question. Can they move on without it? And that seems to be maybe what we're seeing in some of the earnings.
This stock is surging. LVMH up by almost 12%. Intel is plunging in pre-market trading. The chip maker's first quarter outlook coming in much weaker than estimated. Sales expected to fall about $1 billion short of estimates. A signal the once dominant semiconductor company is losing ground in the lucrative data chip market. Bloomberg's Ed Ludlow from the West Coast to the East Coast joins us this morning. Morning, Ed.
Yeah, good morning, John. Look, whatever the story is with the semiconductor sector, be it a rebound in end markets coming off the bottom, or an expanding addressable market for AI chips, or a government-backed onshoring of this industry, Intel just didn't do enough to show investors that it's in the race. The stock is down 11% in pre, putting it on track for its biggest drop since the end of October. There's only so much patience investors have, and this is a turnaround plan that's been in motion for quite a long time. And you ask, at what point are you going to turn around?
Well, let's talk about it right now. How difficult is it to turn around a supertanker if you're Pat Gelsinger?
So it's very difficult for a very specific reason, that right now, from an investor's perspective, but also from an end customer's perspective, there's only one game in town for the most important market, which is cloud, and that game is NVIDIA, the H100, soon to be the H200 or GH200 Grace Hopper. And there isn't enough evidence that whatever they're offering on the GPU side, but also their legacy business in data centers need all kinds of chips, including CPUs. That growth just wasn't there against their previous guidance. And so the market's asking, well, hold on, you're not winning on the basics and you're not showing us the deals, concrete deals on the GPU side going forward. And remember that Intel's also got another plan, which is to take on TSMC and Samsung.
Well, that's where I wanted to go with this. Do we have any sense of whether they've locked in any deals with, say, Amazon or Apple or any of the other major tech names to manufacture their chips?
No. No, we don't. And what they said is we have $10 billion of lifetime deals. But as you guys know, if you drop a name into a conversation, it can sometimes give you some weight. When I flew out here, my wife said, "Are you going on TV?" I didn't say, I'm going on TV. I'm going on Bloomberg Surveillance. And that's a funny analogy, but it's what the market wants to hear. Stop giving us a number that could be future orders or backlog catalog and tell us who that name is. There was a critical piece of news 24 hours ago, which is a deal with Taiwan's UMC. But it's really important to note that while that's a capacity deal on the foundry side for the US, it's based on depreciating assets in Arizona that are obsolete, not the cutting edge of manufacturing.
Well done. You can come back. That was a very good plug. I will say, though, when you talk about building potential chips for other companies and competing with TSMC, We talk about policy. If you build it, they will come. And Intel's gotten a lot of money and will get a lot of money to build some of these foundries in the southwest of the U.S. Is it going to be worth it? Are they going to be doing anything there?
Traditionally, these are highly cyclical end markets, right? And the risk is that you build up all this capacity only leading to long-term glut in supply, right? And the difference this time, and this goes to the reporting we've done around Sam Altman really worried about the future supply of AI chips, is that the addressable market for AI accelerators, chips that go into data centers to power AI function, is just infinite. Everyone is upgrading what they think the dollar volume will be in 2027 or the demand from a unit perspective in 2030. And that does give the bulls, at least in Intel's case, some positivity. But the whole bull thesis is predicated on that idea that Intel's going to be in the race. And they're just not giving evidence now, and therein lies the problem of a turnaround story.
I thought governments were going to help them. What's happened to all that money? Where is it?
So what I'm hearing from sources is that the CHIPS Act is fantastic, but in real terms, you don't just get a check in the mail or a wire from the US government. Accessing the capital is very hard. And it's also multifaceted. Pat Gelsinger talks about this smart capital approach. You take money from your balance sheet, you take money from the government, and you get a strategic investor. Keep an eye on the strategic investor part going forward. But waiting to receive it and then acting on it takes time.
Meanwhile, this is just the first of a lot of the chip makers that are going to be coming to market. NVIDIA coming in later February. How much is this an idiosyncratic Intel story? And how much are there notes of maybe something it's a bit broader here?
So clearly there's going to be an impact on the NASDAQ 100 or index level today in the moment, but it's idiosyncratic. And, the story for me, and I take Tesla into account on this, is where do you want to find EPS growth? You find it with NVIDIA, strip out Tesla, and it's a magnificent 6. And the only other place you can look for it is the utilities sector, which I don't cover. So this standalone decline of 11% is isolated to Intel. Take TSMC's numbers from Taiwan. Take Texas. It's a mixed picture still on how end markets are recovering. But basically, AI is still the only story in town. Investors are willing to back that story. But in the bottom line and the top line, from a volume growth perspective, it looks very good.
Ed, this was great. It's got to catch up, as always. Ed Ludlow there. Look at the moves we're seeing in the pre-market. I want to compare and contrast this. Pre-market, and then we'll do year over year. Pre-market, Intel's down about 10%. It's pulling down the rest of the chip makers. Bramo, over the year, look at these numbers over the last 12 months or so. Phenomenal. So Intel's up 65, sounds all right. NVIDIA's up 211. Advanced Micro Devices up 140, Qualcomm up just 15%. There are clear winners, standout winners in this segment over the last 12 months.
Yeah, Jim Breyer of Breyer Capital actually says it should be a magnificent 8, and AMD should be in there as well. But to the point of what we're seeing with NVIDIA, they're going to be reporting on February 21st. And the theme with NVIDIA is get all of your expectations, inflate them, and then they're going to blow those out of the water, because what they've done with earnings has been tremendous. This has been the NVIDIA rally. Everything else is just trying to catch up with it.
Must-watch conversation a little bit later. Pat Gelsinger, the Intel CEO, Bloomberg Technology, a little bit later with Ed Ludlow and Caroline Hyde. Financial markets look a little bit like this morning. On the S&P 500, we are negative by 0.15%. Let's get a full market shake for you and look at equities, bonds and foreign exchange, starting with what's happening in equities. In the equity market, we're down about 0.15%. In the bond market, we are looking at about 411.43. Yields totally unchanged. And in foreign exchange, 108.73. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahira Hackers. Hey, Yahira.
Hi, John. Bank of America staff will share a roughly $800 million bonus pool of restricted stock, boosting pay to retain employees, even as the bank works to keep a lid on expenses. About 97% of the global workforce is eligible for the incentive, which goes to workers who earn as much as $500,000 in total annual pay. EU leaders are moving toward an agreement next week to transfer some $54 billion in aid to Ukraine. That's according to Latvia's President Edgars Rinkevics.
I do hope that at the end of the day, all 27 members of the European Union will be able to agree. I don't see any reason not to.
EU leaders return for a summit on February 1st to finalize a deal. Apple is revamping its iOS, Safari, and App Store offerings in the European Union, aiming to appease regulators set to impose tough new antitrust rules. The overhaul will support third-party app stores and gaming services for the first time. That's your Bloomberg Brief. John?
Yahira, thank you. Up next on the program, President Biden hitting the campaign trail.
The experts from the time I got elected were insisting that a recession was just around the corner. Every month there was going to be a recession. What recession? Growth ended accelerating in 2023.
What recession? That question up next. You're watching Bloomberg Surveillance. Very close to all-time highs on the S&P 500. Futures pulling back just a little bit. We're down 0.17% on the S&P. Yields are a little bit lower by not even a basis point on the 10-year, 411.62. Under surveillance this morning, President Biden hitting the campaign trail.
The experts from the time I got elected were insisting that a recession was just around the corner. Every month there was going to be a recession. What recession? Growth ended accelerating in 2023. Thanks to the American people, America now has the strongest growth, the lowest inflation rate of any major economy in the world.
President Biden looking to capitalize on the robust fourth quarter GDP report, the latest Pew poll showing a 9% increase in Americans who have a positive view of the economy compared to a year ago. But Biden's overall approval rating, Annmarie, remaining at just 33%. We'll be hearing a lot more from both Biden and Trump in the coming weeks as they prepare for the South Carolina primary on February 24th.
Yeah, absolutely. The economy is still ranking large, Jonathan, when it comes to why voters want to go to the polls. Greg Valliere is discussing this morning in his opinion piece. He's talking about how weighing in on how critical Biden will be connecting to the economy for those voters. A better economy with data to support the improvement is a big deal. This looks like a Goldilocks economy. And if Americans finally begin to believe that, Biden has a decent chance. Let's see.
Get to Greg Valliere right now, the chief U.S. policy strategist at AGF Investments. Greg, let's start there on the economy. Annmarie's asked this a few times. Is the calendar on his side? The moves we've seen in financial markets, developments in the economy, do you expect that to show up in the polls anytime soon?
I think it's a good question, John. I do think the calendar is on his side largely because had these great numbers come out in June or July or August, it might have been too late. But we're in January. And I think over the next 2 or 3 months, there'll be more data confirming that we're not going to have a recession. And that news comes at a pretty fortuitous time for Biden.
If the economy is doing better and Americans do start to feel better about the economy, Greg, what happens next for that issue that's neck and neck for the economy and top of voters' minds, immigration? Because what we're hearing right now in Congress, that potentially a deal will not get done.
Well, I'd say, first of all, Annmarie, that if Joe Biden loses re-election, I think it'll be because of immigration. He's not handled it well. He doesn't really have a plan. But this is compounded by the new Speaker of the House, Johnson, and, of course, Donald Trump, who are urging their colleagues not to act because they don't want to give the Democrats a victory. That's pretty cynical, even by Washington standards. But I do think that we won't get a deal. The intriguing question is, can we get a separate deal that gives money to Ukraine? I do think that could happen.
When it comes to Mitch McConnell, there's a lot of reporting that behind closed scenes, he basically said, capitulating on this deal that he was pushing for. Is there any chance you see before November, potentially him being able to rally the troops in the Senate and get something done on immigration, given all the work that's been put into this? And the Republicans might lose a generational moment in time to get something done.
I know, but I think they view the election and a big election issue as more important. I think the key variable here is going to be, do we get another big surge like we had before Christmas? I mean, we were getting like 10,000 illegal immigrants a day before Christmas. We had nearly 2 million last year. If the numbers start to spike up again, then I think that would be an incentive to do something.
You mentioned Speaker Johnson. He also has a really tight rope to walk when it comes to this potential tax bill, as well as what that's going to mean for child credits. Does he put that on the floor?
Well, it looks like he's not anxious to get any kind of a deal, and the hardline conservatives in the House don't want him to do anything. He's on a very short leash, as you know, and I think that if we see Johnson not cooperating, he could suffer the same fate as Kevin McCarthy. He could get the boot.
Given the fact that Trump has kind of gotten clearly the leadership position, he is going to be probably the person running against Joe Biden. Does it make it less likely that we're going to get anything done in Congress, that we're going to get some sort of government shutdown, that there's going to be this real fissure that just gets accelerated because any deal just simply will help Biden look better, which could really harm potentially Donald Trump?
Yeah, I tell you, Lisa, I think it makes it more likely that we'll get nothing done, that they won't want to give Biden any kind of a victory, and they'll just spin their wheels, do nothing. Again, as I said, I'm pretty cynical, but even by my standards, this is really cynical.
We started on the economy, and we're going to be getting the core PCE deflator later today, which is the key inflation metric. What do you think this administration is getting wrong in messaging?
I think they probably don't appreciate the psychological damage that was done to many Americans during and right after the pandemic. I think they were quite nervous about their own personal budgets. And that hasn't changed yet. I think the public is still of the belief that the economy is not good. I was at a conference earlier this week of retail investors, and I was telling them I thought the economy was getting better, looking good. They thought I was crazy. They thought I was delusional. So there's still a strong opinion that the economy is not good, even though I would argue the numbers lately have been quite encouraging.
It's hard when inflation hits groceries to the degree that it has, and that seems to be what people have been talking about. We did hear from Janet Yellen yesterday at the Economic Club of Chicago, and she was talking about prolonging some of the tax cuts from the Trump era. What do you make of this, sort of this concern about the deficit on one hand and a need for fiscal responsibility, and then talking up tax cuts in a new push on the other?
I think you could make a compelling case. We should do nothing. Everybody's saying let's cut taxes, let's spend more. No, I don't think this economy needs any more stimulus. I don't think it needs any more spending. I don't think it needs any kind of big new tax cut, maybe a small one on the child tax credit. But I think if it ain't broke, don't fix it. And I think there's a temptation in Washington to overreact to every problem.
Let's talk about what is broken, just to wrap it up, Greg. Plenty of things are broken, but this specifically, the lessons from New Hampshire and the ability of the former president to attract moderates. Greg, with that in mind, is he thinking about a running partner that can do just that for him?
I thought the exit polls were really significant, John, in New Hampshire. It showed that a lot of moderates don't like him. A lot of suburbanites don't like him. He has very bad numbers. And I think there's a compelling case that Trump cannot win the election just with his base. He needs to expand that base. And there was no sign that he did that in New Hampshire.
So when he says things like, if you donate to Nikki Haley, we won't accept your money, Greg, what are the chances that he actually will?
He'll take their money. I think that's a hollow threat. But I think the relationship now between Haley and Trump is so poisoned that her chances of being the vice presidential candidate are very slim.
Anyone in mind, Greg?
Yeah, let's watch two people who I think are ambitious and may move. One is J.D. Vance of Ohio. The other is Elise Stefanik from upstate New York. They're both passionate Trump supporters. They're both articulate. They're young. And I think you're going to hear a lot more about the two of them.
Greg, good to hear from you. Greg Valliere there of HF Investments. Thank you, sir. The view from the administration coming up a little bit later this morning. Wally Adeyemo of the US Treasury joining us at 8 a.m. Eastern Time. That's the lineup. AMH, let's talk about the names that he just threw out there. What do you think?
Well, what's interesting is, as Greg said, those names are already within Trump's base. So if he's looking at these numbers, and to Greg's point, New Hampshire showed he has issues with some suburbanites, he has issues with independents, then you really need to go outside the 30% MAGA stronghold and get someone that relates to them, like Nikki Haley, but potentially has the fuel already been blown up between those two in their former relationship, that's not possible. But if you want to get the entire party, he needs to look elsewhere than Elise Stefanik and J.D. Vance.
I've actually read Hillbilly Elegy.
So did I.
Yeah, it was an interesting book, and it sort of gave a window into where he's coming from.
You know what was funny about that book? The liberal left loved that book.
I know.
And then he started getting into politics, and all of a sudden they don't like the guy anymore, which is, it's kind of funny.
Well, it's a question of policy versus story.
Sure.
And there's a question of how you bring people together through a story that a lot of people could relate to.
Coming up in the next hour, Mohammed Al-Arian of Bloomberg Opinion, Sarah Hunt of Alpine Saxton Woods, the brilliant Bob Michael of JP Morgan Asset Management. They're all brilliant before anyone gets jealous. All of that in the next hour from New York City this morning. Good morning.
We're at a point now when we're expecting the broader market to really do well.
You may not be seeing the broadening out if you just look at tech, but if you look at the dispersion that's happening in the Magnificent Seven, it tells you that something is brewing.
For the market, still this disinflationary trend, I think, is the number one story.
We've taken the punch bowl away, and markets haven't fully adjusted.
This is just an unprecedented economy, and we have to manage a bunch of different factors.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
We are on the longest winning streak since mid-December on the S&P 500. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance alongside Lisa Abramowicz, together with Annmarie Hordern. I'm Jonathan Ferro. Your equity market on the S&P 500 just a touch softer, lighter, lower, negative by 0.1%. It's been all-time high after all-time high all week this week, and it's not just the equity market. Lisa, it's the credit market too.
Basically, everything rallying. Credit spreads globally now at the lowest levels going back 2 years. People basically coalescing around this idea of a soft landing. All of the data pointing to stronger growth and more disinflation.
The White House has been absolutely loving it. The President of the United States trolling everyone who called for a recession. The Treasury Secretary Janet Yellen saying the bad part of the inflation story is over. Is that going to translate into the polls through the year ahead?
We have to wait and see. So far, the polling that we've seen, Biden continues to get poor remarks when it comes to the economy. Americans are not yet feeling this disinflationary scenario. But again, the timeline might be on their side. The Michigan Consumer Sentiment Survey that was recently out, although that is a little bit partisan, depending on you ask Democrats or Republicans what they think about the economy, they answer where some of their political lines lie. But the fact of the matter is, Americans are starting to feeling a little bit better, but can they sell this going into November?
I keep reflecting on a couple of conversations I've had with Uber drivers, and I'm not going to base my entire thesis on that. But one guy said, you know, $5 used to be able to go in the store and it would buy you something that you could actually eat. And now it really can't in the same kind of way in the city. And that's really problematic. It's making him feel really negative. So people say, well, it'll just take time for people to adjust to these. Is there enough time before November for people to adjust to prices at higher levels than they were, say, in 2020?
This is the challenge of communicating this, and I think you're absolutely right. For consumers, it's about the price level. It's about the adjustment, the cumulative inflation we've seen since 2020, and we've talked about the scars of that. What Diane Swonk said recently, and we're all fans of Diane Swonk, you need this labour market to stay pretty decent. You need wage growth to continue climbing. You need time, to your point. The problem I've got with the economic data at the moment, Lisa, and we're both on the same page about this, I know, so much of it is in conflict. So headline payrolls data looks good. Beneath the surface, the breadth of the gains, it's really narrow. Just a couple of industries. I think you see this in earnings too. Let's take Visa yesterday, compare it to, say, Capital One. We both look at the same thing. Yeah. Visa saying consumer spending remained resilient. What stands out for Capital One? I'll tell you. Borrowers falling behind on their credit card and auto loans. Which one do you think speaks to where the American population is at the moment?
It's the one of LVMH versus Kmart. That is what we're talking about, essentially, which is that people who have money will keep spending and be able to pay for it. People who have to borrow at 10% rates to buy a car are having trouble with underwater loans paying it back. And you're seeing that in the Capital One figures, not necessarily in the Visa figures. And these disparities point to a much more complicated picture than simply the headline numbers suggest.
We've seen that conflict all year, haven't we? Here's the broader price action for you this morning, at least, and good morning to you all at home. The equity market on the S&P 500 negative here by 0.1%. Into the bond market, 411.43 on a 10-year. Into the FX market, just in and around 109, 108.75. Lisa, we heard from the ECB yesterday. I wonder if the message is going to be any different from Chairman Powell and the Fed next week.
She was echoing Jay Powell from December, which is essentially whatever the markets are saying. I don't usually go back on them. She didn't push back. She could have pushed back, and essentially now we have a 90% pricing of an ECB rate cut come April, a 50 basis point rate cut in total being priced in by June.
Shima Shah says that summer's going to come early because if Christine Lagarde continues to be data dependent, as she says she is, then her date is going to have to change.
Going to have to move forward, potentially to the spring. At least she's not going there just yet. What did she say yesterday? I didn't talk about rate cuts today, but what I told you before still holds? And they talked about rate cuts?
She says she stands by her words, but also, and we didn't cut the full version of that, it was a Bloomberg reporter asking her, and she said, but how you interpreted what I told your TV channel is a little bit different than what I said, but I stand by what I said, which was likely summer.
OK, super helpful that, super helpful. Over the next 60 minutes, the programme looks like this. Mohammed Al-Erin of Bloomberg Opinion and Queen's College, Cambridge on the resilient US economy. Sarah Hunt of Alpine Saxon Woods with stocks closing in on a third week of gains. And JP Morgan's Bob Michael on the Fed's path forward. We begin with our top story this morning. Better than expected data boosting optimism for a soft landing.
Just last week, we saw the biggest jump in 30 years in how positive consumers are feeling about the economy. Things are finally beginning to sink in. We passed a lot of really good legislation. We knew it was going to take time for it to begin to take hold, but it's taken hold now and turning the economy around.
But Mohammed Al-Erin of Queen's College, Cambridge, writing earlier this month, the Biden administration cannot simply rely on lower inflation to alleviate voters' concerns about its economic management. It needs to communicate more effectively the exceptionalism of US economic performance. Mohammed, I'm pleased to say, joined us now for more. Mohammed, good morning. I think you're right on the money. Nailed it. This is a big, big issue for communication in the White House right now. Can you give us what you think they should do in the weeks and months to come?
Sure, John. Thanks for having me on. They have to translate things that they've achieved and that the public doesn't appreciate. Amazing job growth, very strong economy. You know, remember, even Bloomberg said 100% probability of recession in 2023. Instead, we've ended up with a 5% third quarter, a 3.3% fourth quarter. Remarkable. Stock markets, record high. And it's the only advanced economy that is investing in the drivers of tomorrow's growth. That is a long list of achievements. And yet, if you ask the person in the street, and Annmarie talked about the polls, they think that the administration has mishandled the economy. There's two reasons for that. One is inflation. You're absolutely right. People think in terms of price level. So for them, when you say we are winning the war over inflation, they think that that means prices will come down, not that the rate of price increases will come down. And the second thing is they haven't communicated in a manner that translates this to the everyday. So you need a lot more consistent communication, and you need it simplified so that the person in the street understands why not only are they better off than they've been before, but the prospects is that we have new growth engines coming in.
I'd also argue, Mohammed, you need the labour market to hold up for the rest of this year, to allow the scars of inflation to actually heal. Do you think the easing of financial conditions over the last few months, let's go from the end of October, Mohammed, do you think that's sufficient to delay any weakness in the labour market?
I don't, because a lot of this is like pushing on a string. Corporates will be able to refinance at lower rates, mortgages slightly better, but the reality is that there's structural issues. I mean, that is the big risk for the administration, is that the economy slows this year because some of the drivers of last year's growth are no longer there, including high savings. And secondly, inflation stops going down. You know, John, I've said we are in the sweetest spot of the inflation reduction right now. It's going to get tougher going forward. And we've already seen from Europe that it's not out of the question that not only does inflation stabilize, but once in a while you get the rate going up. And that would really impact perceptions.
The White House is so excited to lean into this, Mohammed, soft, very soft landing expectation. The timeline may be on their side. But when you look out to November, where are the vulnerabilities to that soft landing?
So the vulnerability, there's three of them. One is what the external world is imposing on the U.S. It is getting harder to grow in this global environment. We have disruptions of supply chains. We have cost pressures in the pipeline. We have delays in shipments. All that has a marginal impact. Two, the consumer is going to be under more pressure. You've talked about debt levels in the previous hour. Savings have come down. We no longer have the pandemic savings being utilized to the extent it was before. So there's a real risk that growth slows to the 1 to 1.5% level, with downside that we may slip into a negative quarter. And then thirdly, inflation. We need inflation to keep on going down. The market expects that it will do so in a much more orderly way than I think will materialize, unfortunately.
I'm struck by something. I keep thinking about this. Cameron Dawson said, Mohammed, where she was saying she's checking for pricing power among a lot of companies that are going to be reporting earnings. If they don't have that much pricing power, that's great news for disinflation. That's very bad news for their bottom line in terms of just their margins. How much is this sweet spot for disinflation not necessarily a Goldilocks spot for a lot of the stocks that are getting bid up simply because it means margin compression down the line?
Oh, and you're seeing it. I mean, my big theme for this year is dispersion. And just look today, we're realizing that not all tech is tech and not all luxury is luxury. That is what the results are telling you between Intel, on the one hand for tech, and on the other hand for LVMH. What you're seeing is growing dispersion. And some companies will have pricing power, others will not. And we are going to see this dispersion. Now, the market right now is betting on a very aggressive rate cycle, allowing for everything to go up, because that is the experience since the global financial crisis. As long as the Fed loosens, everybody benefits. I think this time around, we're going to see a lot more dispersion than we've seen before.
Deutsche Bank says we'll get a reality check later this year. They're looking for, say, 10% downside on the S&P 500. It's not particularly unusual. Are you expecting that kind of reality check, Mohammed, anytime soon for markets, given where stocks are at all-time highs? Spreads, global credit spreads, incredibly tight.
John, I'm not in the business of predicting whether it happens and when it happens. And where people have been wrong in the past, including last year, is ignoring the technicals. And the technicals right now are incredibly favorable. So the big question for me is what breaks favorable technical? By that, I mean there's still money in the sideline that can be put to work. So dips will be viewed as buying opportunities for a while. Look, John, the thing I worry about most is the sense that growth is going to disappoint with a downward risk, the balance of risk on the downside. This comes against the universal romance with the softest of all soft landing. And then secondly, a recognition that the Fed is not going to validate what's being priced in right now in terms of cuts.
Chairman Powell next week, what kind of message are you expecting? The one we heard from Williams a few days after he spoke in December, or the one we heard from Powell at the December news conference?
Or the one we'll hear at the beginning of the press conference versus the one we'll hear at the end of the press conference. I don't know.
True. It's been confusing, Mohammed.
Sorry?
It's been confusing.
It has been confusing. Part of that is that this is a confusing time. People that I talk to privately, expectations, John, are all over the place. There are people who think they won't cut rates until the summer, and then we'll get 75 basis points. There are people who think they'll start in March and they'll front load it because of the elections. There are people who think, like me, that they're likely to wait until much nearer to the summer and then start with 25 basis points. Expectations are all over. And what's really interesting is that forward guidance has lost its power. The Fed has been very clear in terms of its forward guidance. And the market's saying, yeah, sure, but I'm not going to listen to you. That's really problematic.
You said you're not in the business of predicting the future. Can I just jump in and get you to predict the future? When's that first rate cut coming, Mohammed?
My own gut feeling is that it will come at the beginning of the summer. So call it June, maybe July, and it will be 25 basis points. And not only do I think that that's what's going to happen, I think that that's what should happen.
OK. Mohammed, appreciate your time today, this morning. Thank you, sir. As always, Mohammed Al-Erin of Bloomberg Opinion and Queen's College, Cambridge. Lisa, what do you make of that?
Just the idea that this is what they should and this is what they will do, which means pushback. And frankly, it means a lot of repricing in the markets. That's all I can say. Because right now you have a significant lean, about a 0.5% chance, 50% chance of a rate cut come March.
Not in the business of predicting the future, but we got him to predict the future just a little bit towards the end of the conversation. Equities right now on the S&P 500 negative here by 0.1%. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahira Hackers. Hey, Yahira.
Hi, John. The Biden administration has frozen approvals for new licenses to export LNG. Officials say they need time to scrutinize how shipments affect the climate, the economy, and national security. The halt will likely disrupt plans for billions of dollars in projects. President Biden saying, quote, "This pause on new LNG approvals sees the climate crisis for what it is, the existential threat of our time." Some major U.S. chains are dealing with a growing number of Middle East consumers boycotting Western brands over America's lack of action to try and end the Israel-Hamas war. McDonald's and Starbucks are among the companies affected, while one local Egyptian soda brand said its sales have tripled since the war began, as consumers boycott Coca-Cola and Pepsi. Shares of LVMH are surging after the luxury retailer saw sales rise at the end of last year. An increase in sales of handbags produced 10% growth in revenue over the final quarter, with the company's billionaire CEO saying he was, quote, "very confident for the year ahead." That's your Bloomberg Brief. John?
Yahira, thank you. Coming up next on the programme, volatility on the horizon.
A higher volatility backdrop, both in terms of the macro conditions, including inflation, and the market, I think should be part of the assumption as we, continue in this year.
That's coming up next on the programme, live from New York City. You're watching Bloomberg Surveillance. Six-day winning streak on the S&P 500. We might just snap that. We might. On the S&P, we look like this. We're negative 0.05%. We're going absolutely nowhere in the equity market and in the bond market too on a 10-year 411.24. Under surveillance this morning, volatility on the horizon.
You got volatility so low that to some degree it's just a simple reversion to the mean. You can only go so much lower before you see it turn back up in volatility. So a higher volatility backdrop, both in terms of the macro conditions, including inflation, and the market, I think should be part of the assumption as we continue in this year.
Between mixed messages from the Federal Reserve on interest rates, geopolitical instability and the presidential election less than a year away, investors are bracing for the unpredictable. Sarah Hunt of Alpine Saxon Woods writing this: "The growth in earnings and drop in rate scenarios needs to find a common narrative. At the moment, it seems difficult to square the circle of a market looking for both 10% plus earnings growth and deep cuts in interest rates." Sarah Hunt joins us around the table. Morning, Sarah.
Good morning.
So it's your job to square the circle, please.
I don't think we can. And I think this is the biggest issue right now, is that you've had this big move up in multiples. You've got this expectation that the Fed is going to cut rates, at least from the market's perspective, more than the Fed is telling you. You've got this growth in earnings while you're seeing fourth quarter earnings coming in fine, but the expectations going forward so far have been a mixed bag. And for many people are just pulling guidance. So how do I square that and say, okay, that should all be fine, and risk assets should just be able to keep performing well in this environment? And I think Cameron made a really good point earlier on margins, which is one of those things that we've been looking at and saying all these things that we're doing are not positive for margins. How does that help?
So which part of the rally are you leaning against the most? Which has gotten ahead of itself?
Well, the parts that have gotten ahead of itself are still the parts that you can't ignore, like the tech sector, right? Because some of those earnings really are growing that quickly. So in some cases, something like NVIDIA, yes, it looks like it's had a huge move and it's grown enormously, but you look at the cash flow that they're supposed to generate and you go, okay, actually, relatively speaking, it's not as crazy as it looks in some other areas. I just think the entire idea that you can just keep pushing risk assets higher while you're looking for all of these minutiae that's going on and the rest of the world not doing that well, it just seems a little difficult, but it's hard to pinpoint exactly where the problem is. Otherwise, you could just say, well, I'm going to short this or I'm going to short that. And it's tough.
Now for the psychology portion of the program. I'm curious how much this is just really a reversal of what we saw last year, that people were so pessimistic and they got it so wrong that now they feel like all of their sort of little voices in the backs of their heads saying, oh, this looks a little concerning. They got to kind of ignore that because it has been a Nirvana economic outlook, at least so far this year.
Yeah, and it's not usually where the narrative changes, when everybody decides that it's okay and it's really different this time and that's all right. I mean, we fight with that ourselves all the time, which is, are we really in this situation where you've got different drivers of market performance. You've got different buyers of equities. You've got hedge funds. You've got macro funds. Does that really change the underneath finance? And when you finally start to say, yes, the fundamental picture has changed, well, the world tends to be, gods with copybook headings come back and say, well, maybe not exactly. So the answer is I'm not really sure. And I think that you've got some time in the near term, but you've got all this stuff coming up in March. Does the Fed really cut? What do they telegraph? What happens with the BTFP, with it expiring? There's a whole lot of things in the underneath that also make it figuring. I think that you're going to see, to Liz Ann Saunders' point, some more volatility.
So, Sarah, what do you like right now?
Well, like I said, we like some of those big tech names that people are that have moved a lot. I mean, the Nvidia's been a big move, but there are some areas that we think that are really, you've got some good cash generation. Some of the other semiconductors are quite expensive relative to Nvidia right now. And I think that even though we like them going forward, because we just think that you're going to continue to increase technology, some of those areas are tough. And there's places in the environment that we like. We like Train, we like the Carrier. We like some of the areas where you've got this giant HVAC replacement cycle that's going into the environmental stuff.
Lisa and I were talking about the conflict in the data and also the conflict in the earnings. I think it's really important just to look at Visa yesterday. Consumer spending, resilient. Then you go to Capital One and they're talking about borrowers falling behind on their credit cards and auto loans. And I'm trying to work out, if I was an investor right now, do I want to own consumer discretionary in America? Is that a story I want to buy?
Well, this is exactly goes to the point of LVMH just having great numbers, and people like Capital One who have on the credit side are starting to see some issues. Discovery started to see some issues on the credit side, the auto loan side. You've got a huge bifurcation in the consumer, and you've got a high-end consumer that's doing fairly well, and you've got a low-end consumer that, to the whole point of this economic backdrop, price levels are still very high. Yes, all those things that Mohamed El-Erian was just talking about in the economy that are good, but it doesn't matter if I'm struggling to put groceries in my cart and everything is so much more expensive than it was.
Just to build on that kind of narrative, we also got American Express just moments ago, and they said that, yes, write-offs not so great, but they expect much better earnings because of robust sign-up to some of the premium cards. So again, it's catering to that richer kind of class. I want to go back to this idea of margins then, and sort of the margin compression and pricing power. At what point is disinflation, which is good for the economy and particularly for lower income families, at what point is that very negative for a certain slew of stocks in terms of their margins that you're watching?
There's always an issue when you've got price level changes for somebody. It's good for somebody, it's bad for somebody else, right? You drop oil prices down, all of a sudden refiners have a good couple of quarters. There's always the input depends on who the input people are and who the output people are and which prices are actually falling. So it's going to be an issue, but I think that margins in general, you've got a lot of cost structures that are going higher. Wages are going higher. They might not be going as high as inflation, but they're going higher. If you can't get continued price increases, which I would argue the automakers are having trouble doing. I mean, look at what Tesla just did. Look at some of the areas that are big. Some of the tech stocks, it's not so much of an issue because if your input into something's ultimate manufacture is a small part of that price, it's much less of an issue than if it's a big part of that price because everyone's trying to cut costs.
What about some of the winners, the airlines, the cruise liners, some of those kinds of areas where it is discretionary spending and there's a real big mix of potential clients?
Well, on the airline side, it's tough because you've got capacity changes all over the globe that are sometimes hard to track and sometimes conflict with where people think that they should be, right? So the U.S. domestic has not been as good as international because there's been additions in capacity on the airline side. There's plenty of places where people are spending money. The question is there enough capacity restriction to make that price for people able to raise prices, which I'm losing my words, but you know what I mean.
Don't worry, it's early in the morning. Let's finish on the autos if we can. We've been doing a round trip. It's like stock market roulette at the moment, so let's finish on the autos. Tesla was down 12% yesterday. This feels like a really difficult moment, and I don't want to just say just for Tesla, I mean the whole industry in America right now, going against the low-cost producers out of China at a time when labour costs, particularly for Ford, Stellantis and GM, are moving in the wrong direction for them. How investable is that sector at the moment, from your perspective?
I think it's very difficult because I think you're looking at an area where you haven't had as much consumer demand because interest rates have gone up, so now cars are even less affordable. Insurance is going higher. There was a story on insurance because cars are more expensive to fix and there's a lot more technology in them. All of these things are driving it to be a much more expensive proposition than it used to be. I think for Tesla, you've got this interim period where they're now promising a more low-cost vehicle to compete with other things, but also because I think you had a huge range of first adopters in EVs. And now EVs seemed a little bit stuck, and all the automakers went all in on EVs because they were told to, mostly by the government and everything else. I think you've got a lot of cross currents. It makes it very difficult to parse what the underlying real fundamentals are.
Bramo, January 26th, and I think we're down about 26% year to date for Tesla. It's been a brutal start to the year.
And that press conference didn't really help, especially with Dan Ives saying that basically it was a train wreck and then a plane crash, and then he just said, it's an understatement. So
but
at
he's
this
still
point,
bullish.
Well, for now.
Yeah.
Wedbush just removed Tesla from their best ideas list.
Interesting. So that's a subtle
shift.
There's
like a subtle shift that's going on under the cover.
Hey, Sarah, it's good to see you, as always. Thanks for being with us in the new studio. Sarah Hunt there of Alpine Sexton Woods. Coming up next on the programme, looking ahead to the Fed meeting, Bob Michael, JP Morgan Asset Management for the next 30 minutes on Bloomberg Surveillance. Brace yourself. Bob Michael, JP Morgan, showing up with attitude, real attitude in a commercial break. He'll be with us in just a second. Equity futures on the S&P 500 look a little something like this. We're negative here by 0.07% on the S&P 500. 6-day winning streak, the longest since mid-December, extending the longest winning streak, daily winning streak of the year so far. On the Nasdaq, we're down about 1/3 of 1%. The Russell, the small caps, up by 0.4. In the bond market, 2-year, 10-year, 30-year, much more on Treasuries a little bit later in this segment. We're unchanged on a 10-year, 4.12 on a 2-year, higher by a basis point or two, 430.97. And just to finish on foreign exchange, ending the week basically where we started the week and ended last week, around 109, 108.70 on the euro, positive by 0.2%. Under surveillance this morning, Treasury Secretary Janet Yellen touting the US economy, telling the Economic Club of Chicago that inflation is, quote, well under control, and that most Americans would agree.
People are getting ahead. They're seeing their fortunes improve. And I believe if inflation stays low, they'll begin to regain their confidence in the economy.
Another read on the US economy coming in just under an hour, with personal spending and the PCE core deflator due at 8:30 Eastern time. Would most Americans agree with that statement?
Not if you look at the polls right now, which are all red when it comes to Biden's approval on the economy, on inflation. Look at this. Economist YouGov poll. This was done January 21st to 23rd. Negative 21 spread on inflation specifically. So it's not catching up to Americans just yet, but maybe it will. And I think she was leaning into that.
I also thought her comments on tax cuts were really interesting. They prolonged them, especially given some of the focus on reducing the deficit and how to distinguish from the former President Trump.
But only with a nuance. If you make $400,000 or less, which we've heard Biden say this a lot. But if you're a little bit above that bracket and Biden's reelected, it's going to be very difficult to get those Trump-era tax cuts through.
Speaking of Donald Trump, going after Nikki Haley and Nikki Haley's campaign donors, saying anyone that makes a contribution to his GOP rival will be, quote, permanently barred from the MAGA camp. I'm not sure how many people believe this. Losses in Iowa and New Hampshire leaving Haley with little chance of winning the GOP nomination, but that's not stopping the former president going after her donors, who contributed around $50 million to her campaign in the second half of last year, slightly more than what Trump received. Annmarie, we heard from Greg Valliere of HF Investments, and I said, will he actually follow through with this? And he just said flat out, no, not a chance.
What politician is going to follow through when a billionaire calls you and says, I can help fund your campaign? And campaigns in America are very, very expensive. I thought what was so interesting about the campaign financing of both these super PACs is Haley brought in more, $5 million more than Trump did, but potentially that's going to start to evaporate.
The other unusual dimension of this, of course, if you look at the lessons of New Hampshire, the inability of the former president to attract moderates. There are some people who believe the perfect running mate would be Nikki Haley. How much do you want to poison the water over the next few weeks?
It seems like Greg Valliere, just to lean on his comments, didn't seem to think that that was a likelihood.
Not happening.
And honestly, after some of the commentary back and forth, it doesn't seem likely. That said, the problem with independents really raises some questions for the Trump campaign.
Well, if Trump wants to win, he might have to look outside a potential MAGA running mate and get someone that's more in the middle so they can actually encompass the entire party. If he has Nikki Haley, she can go out and talk to women living in suburbs. That would help him a lot.
That's the politics. Let's pick out a single name. We've been talking about LVMH. We've talked about Intel as well. LVMH is rallying hard. Intel is not. It's down about 11%. Shares of Intel tumbling after the chipmaker delivered a disappointing forecast, renewing doubts about a comeback for the once dominant company. Intel expecting first quarter sales to come in around $1 billion shy of estimates. The CEO, Pat Gelsinger, saying the company has a lot of work to do. Gelsinger joins Bloomberg Technology at about 1 p.m. Eastern time. What are your thoughts on that, Bramo? Intel's in a tough spot, isn't it?
Yeah, given the fact that profit, they're expecting in the first quarter 13 cents a share versus the expectation of 34 cents a share. You know, we were talking about this with Ed, and it is a mix of what your products are. But to Mohamed El-Erian's point, the dispersion of the haves and the have-nots, it's not just to go into tech. It's to go into the technology that is most leveraged to the current, sort of feel in the business world. Those dispersions are getting greater and greater, which makes it more challenging to really have an overall call that percolates down to the smaller companies or bigger companies.
Well, for Intel, they're just not in the right space, in the right spot right now.
And they're not gaining traction. And how much can you really get a competitive edge when there is already that critical mass in some of the other chip makers and some of the other tech companies?
Intel is plunging, the broader stock market recovering, equity futures right now just about unchanged, counting you down to a Fed decision next week. The data continuing to show a resilient US economy. Bob Michael, Global Head of Fixed Income at JP Morgan Asset Management, writing this: whatever the mirror image of stagflation is, that is exactly what we wound up with. Let's call it economic nirvana. Given the momentum, it's difficult to imagine anything other than trend growth ahead. Bob Michael joins us now. Morning, Bob.
Good morning.
Good to catch up with you, sir. We're not going to talk about Liverpool yet. I'm going to save that for the end of the segment, OK? So just wait for that. Let's talk about bonds and the Federal Reserve first. And this economic backdrop, this is a big change for you. I remember being with you 12 months ago, anticipating that hard landing. Not anymore. Why do you think this can continue?
Well, 12 months ago, there was every reason to expect recession. There were rate shocks delivered. Everything looked frail. I would argue in March we had that recession with the collapse of the regional banking system, but the policy response was overwhelming at the time. And within a couple quarters, we realized it was more like a TARP moment than anything else. So things were stabilized and we took off again. And I think as the year has gone by, businesses and households have managed to absorb the higher level of prices. Yes, they don't like the higher levels of prices, but we're in a disinflationary environment, not an inflationary one, and unfortunately not deflation just yet. So it looks good. I'm tempted to see how much of a high five Jay Powell wants to give himself in the Fed next week.
You think there might be a victory lap?
They're entitled to it. When you look at it, it cannot possibly get better than this. You've had 25 consecutive months of unemployment at 4% or lower, and I guess we'll get another update in about 45 minutes or so. But when you look at the last 6 months of core personal consumption expenditures and annualize that, 1.9%, that's their 2% target. They are there.
I'm not expecting Chairman Powell to walk into the room and start high-fiving Mike McKee anytime soon. I don't think that's ever happening. But Bob Michael, what do you expect he will do next week? Is he going to tee up rate cuts in March, given what you've just said?
I don't think in March. I think June is where the market has gravitated to, and I think that's a good marker for him to put out there. I like what Christine Lagarde did, which is to acknowledge that there has been improvement, that they can think about things, that the level of rates is substantially pulling inflation down, and there's an opportunity to make a shift. When you look at the real Fed funds rate, the Fed funds rate's 5.25% to 5.5%, and if you're around your 2% target, the real Fed funds rate is 3.25%, 3.5%. That's way above what the Fed is telling us is normal.
So how much is your whole idea predicated on the idea that the new normal looks a lot like the pre-pandemic old normal? That you push back against the idea that we're in a structurally higher inflation world that's going to force the Fed, even if they start cutting rates, they can't cut them that far.
I think that's probably true. I think the last 15 or so years were the anomaly. For sure, us baby boomers blew things up in 2007, 2008, when we learned to leverage everything in the housing market. And it's taken a long time to recover from that. But now there's a new generation coming along. Start with the millennials and the surrounding cohorts. And then suddenly, they're not 17, 18 years old anymore. They're in their 30s, and they're the dominant earner, spender, and saver, and that's the environment we're in. Now, you just don't go up to 5, 6, 7, 8% and stay there. We've gone a long way. Things are slowing down. You could take some of the pressure off the system, let things stabilize in there, and then see where the economy goes and what you have to do with rates after that. That's more normal to me.
So if the Fed can't cut rates as far as maybe in the past, or even as people previously thought, just simply because the economy is managing with rates where they are, how do you reason around getting more aggressive in high-yield bonds, which have both a credit component that has gotten very tight and have the rate component, which may not be able to compress as much as some people expect?
So we think they could bring rates easily down to 3%. And if they'll only do that if they're at their 2% inflation target. That's a real Fed funds rate of 1%. And they've guided us to a real Fed funds rate of 0.5% is normal. We'll see as we head there whether that starts to shift. So that's 225 basis points of rate cuts. That's a lot. That takes a lot of pressure off of corporate America. And a lot of corporate America funds itself in the floating rate market, either through banks directly or through private credit markets or bank loans that are syndicated, things like that. It also takes a lot of pressure off of the consumer. Things like housing, maybe that starts to pick up in earnest again. And a lot of the borrowing that's gone on to revolving rate credit cards, that pressure comes down. So you do get a good level of consumption. It does remind me of 1995. And credit spreads can go to 300 basis points in high yield, trade from 275 to 325, and stay there for years.
Bob Michael, you're going to stick with us. We'll expand on that conversation. Some big calls and a big change for Bob Michael at JP Asset Management, constructive on credit. Here's a snapshot of financial markets for you. Equity futures on the S&P 500, almost totally unchanged. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahira Hakez. Hey, Yahira.
Hi, John. Shares of American Express jumping after posting its fourth quarter earnings. The credit card giant is sticking to its long-term revenue goal while missing profit and revenue estimates. Amex is still aiming for annual revenue growth exceeding 10%. Meanwhile, Visa saw an 8% profit increase in the last quarter. Apple is revamping its App Store and iPhone features in the European Union. The overhaul is an effort to appease regulators in the region, which are set to impose new antitrust rules. Still, the tech giant is mounting a legal challenge against the Digital Markets Act through the EU courts. And Liverpool manager Jurgen Klopp is stepping down. The football club chief said in an interview posted on X he will leave the club at the end of the English Premier League season. Klopp has been at Liverpool since 2015, winning 6 trophies, including the coveted Champions League. He said he is, quote, running out of energy. That's your Bloomberg Brief. John?
Yahira, thank you. Had a tweet moments ago. Could we get a moment of silence this morning for Klopp leaving Liverpool? Massive shout out to Annmarie wearing red in solidarity. She knows. She definitely knows. AMH. Bob Michael, tell us your thoughts. Liverpool fan. Jurgen Klopp.
The first thought is shock and horror. It's brutal, particularly when you're a bond fund manager and been through a 2-year bear market. Now this. But the reality is, he did us proud. He brought us back to the top. You heard 6 trophies. So I wish him the best. I don't think he's done. I think he winds up managing a national team.
Oh, really? You think that's where this is heading? Germany?
I'm hoping the U.S. or England.
That's where you think this is going?
I don't know where, but someone with his talent, he'll get restless after a period of time. And I think a national team's a good spot for him to
Well, he's still young. Unbelievable manager for Liverpool Football Club over the last 8 years or so. Bob Michael's going to stick with us. Up next on the programme, the outlook for credit.
One of the really interesting things from my perspective is this kind of significant demand for corporate credit to start the year.
Constructive on credit, not just BlackRock, but JP Asset Management as well. That conversation up next. Live from New York City, good morning to you. Equities on the S&P 500 shaping up as follows. On the S&P, we're negative by just 0.03% after a 6-day winning streak on the S&P. Under surveillance this morning, the outlook for credit.
One of the really interesting things from my perspective is this kind of significant demand for corporate credit to start the year. Some folks are rotating out of short-term cash products into corporate credit. Some are rotating out of other asset classes. Some are kind of bringing their allocations back to neutral where they may have been underweight. So I do think that there's a broad-based kind of appetite to lock in all-in yields.
There is a lot of appetite. Bob Michael writing this. We retain a significant core holding in investment-grade corporate bonds and securitized credit. Credit spreads have narrowed, but history shows us they can stay there for a period of years. Bob Michael's back with us. Bob, we mentioned this just briefly. Let's build on it. What's changed for you in the last few months to become constructive now on various places in credit?
What's become constructive for us is that the probability of recession has pretty much vanished over the last couple of quarters. And if you're in a soft landing and in an environment where inflation is moderate and the Fed can bring down rates, that's great for corporate America. The financing pressure comes down, consumers are out spending. We've seen that the last couple of quarters. Credit spreads tend to come in. You want to be a holder.
We've seen tons of supply to start 2024. A question we've asked through the week, we asked it of Amanda Liner at BlackRock and Priya Misra as well when we had the conversation about credit with her, your colleague. Is this catch up from last year or pull forward for this year? How do you view the issuance, the supply we've seen so far?
I'm going to tell you something surprising. Between Treasury supply and corporate supply, I'm worried there's simply not enough. And I almost wish the Fed wouldn't start tapering QT. And I almost wish they would push out interest rate cuts a little bit further and go once a quarter instead of starting in May or June and doing every meeting. There is so much money looking to come into this market. You look where levels got to. Levels got here in credit spreads and yields simply with the money that's already in the market. I've not had a single conversation over the last couple quarters with a client who said, oh, get me out of bonds. Every single one is saying, how do I get in? When do I get in? Where do I get in? And you see it everywhere. You see it in money market fund assets. They're still at $6 trillion. You talk to corporate treasurers and pension fund CIOs. They're looking to de-risk. Everyone wants higher yields.
So this is a fascinating idea, the scarcity of bonds question, which has come to the fore a number of times in history. How much is this because a large chunk of corporate America are going to private markets to borrow and not to the public market, so that there's sort of a limited pool of these types of securities?
I think that's some of it. I think the other thing that's happened is the backup in yields happened pretty quickly. Everyone wanted a bit higher, thought we would spend some time there, and then it's starting to reverse. So it feels a little like this time last year. So a lot of plan sponsors are a bit frozen, and rightly so. You look at the Treasury. The Treasury has moved a lot of its issuance to the front end of the curve. I would argue put it out in 10 and 30 years, get those rates up or keep them where they are, allow people to get into this market who are going to be long-term holders. I think also private credit has served a lot of purposes. The most important one from our perspective, it's another avenue of non-bank lending that's materialized. And that's created a fantastic pool of capital that's available to backstop corporate America as well. So if you're a company, you can go to your bank. If you're large enough, you can go to the public markets. And the private credit markets are amply large as well.
What happened to all the zombies out there that were supposed to collapse in the wake of higher rates?
Well, you see it. There's just, look at the bun fight going on to finance Macy's now. There are so many different things that are happening that tell you there's so much committed capital that's waiting to be called and invested that nothing can really default. It just gets rolled over and restructured. I know it's insane to say that. I know we're going to have defaults, but as you're getting into an environment where recession looks in the rear window and where there is ample liquidity around and the availability of credit is everywhere, it's a pretty easy environment.
Where was this message back in October when the 2-year was 5.26 and the 10-year was through 5%? I don't remember people coming on the programme and saying there's not enough bonds. I think they were saying there's too many treasuries. Why is it different this time? I mean, it literally was 4 months ago. I'm kind of sitting here scratching my head thinking there's not enough bonds. We've been complaining in the Treasury market there's too much supply.
Yeah, I wasn't complaining about that. I was always one who was saying the worst decisions get made on supply and demand in the bond market than anything else. You just have to ignore it. But if you go back to September, there was still a lot of concern that maybe the Fed would come back and hike rates again. It was unclear what the Fed's message was. Now you've gone another quarter and a half, 2 quarters. The economy has done better than anyone anticipated, and inflation has actually done better than anyone had anticipated. And you've got that momentum heading into 2024.
You don't sound concerned about America's financing needs. this monster budget deficit, which could become a bigger monster in years to come, depending on who gets into power. But basically, whoever gets into power, it's a massive deficit. You not concerned about that?
Not today, only because I saw the need for it. We had a pandemic. You needed an overwhelming policy response. We had that fiscal and monetary. Now we're coming out of the other side. We're still in the shadow of COVID policies. You have to work them out. You can't keep piling up on them. You've got to let them come down. So I'm all for that. But I don't think you bring it down all at once.
Let's build on that, this idea that maybe it's not this year, but next year, that people start to get a little bit more nervous, especially as interest expenses continue to rise and some of the expenditures that are just baked in continue to increase. At what point do you care about supply, or is it never really an issue? It's just a matter of what the yield is and the fact that people want to lock in income.
Well, we're in economic nirvana right now, and one of the things the Fed can do to keep us there is to start to bring rates down. And if you go back to 1995, that was critical to have a soft landing. They cut rates 3 times by 25 basis points. And that took some of the funding pressure off of businesses and households, and that allowed things to stabilize. So I do think that's a necessary ingredient. We can't just assume everything's fine now, let's not touch anything. We've got to start bringing rates down at some point in time. And then I think things look pretty good.
To John's point about fiscal deficits, we've seen a 79% increase since 2019 of debt to GDP. The CBO says it's going to be 118% in 2033. Is the U.S. going to get comfortable running Italy or Japan-sized deficits?
I hope not. I think every household, including all of ours, we have to balance our budgets every year, and I hope our federal government will do the same thing. I also think that ship has sailed. Coming out of the financial crisis, there was a lot of talk about financial repression and debt to GDP at over 80%, 100% takes so much off of GDP, and that hasn't proven to be correct. And in fact, when you look at countries like Japan, which have mid-300s debt to GDP, you can keep it there forever. I hope that's not the case. I hope there is fiscal responsibility in place over the coming years in Washington, and we bring it down. But I understand how we got here.
And Mike McKee writes in, just subject header, nothing else. Ask Bob what my question should be next week in the Federal Reserve. This is a monthly tradition every time the Fed gathers. What should it be next week for Mike McKee?
Really? He wants it a week early on me?
I think he's worried you're not going to show up next week on Bloomberg.
No, I think actually I am back next week.
You're going to be back next week? Good.
Yeah,
no.
We
can do it twice.
I think he has to pin them in on how they view quantitative tightening and how they see the roadmap for that. And if there's enough demand for treasuries, then do they need to start quantitative tightening, or how much are they concerned about another repo incident that we saw in 2019?
Do you think we need to get through QT before we can start talking about cutting interest rates? Is that the sequence of things for you? Can we do both at the same time?
But both certainly help. If you think there are 2 very large sellers of treasuries out there, there's the Treasury funding the government, and then there's the Fed running down its balance sheet. That's another huge you take one of those out of the equation by tapering QT, suddenly a headwind becomes a tailwind.
Mohammed was on the programme in the last 50 minutes. He said he doesn't predict the future for markets specifically. He will with the Fed. Can you do that for markets? Talk to me about the bond market. Well, where do you see yields coming down to? I remember the call of 3.0 right through the curve, 2s out to 30s. Is that still the call?
So we're in the markets. We're investing client capital. We have to have a view. I can't sit here and tell clients, I'm sorry, we have no view. We've just plunked $800 billion into whatever happened to come across our doorstep. And our view is there is a soft landing. There's capacity for the Fed to bring rates down over time to 3%. That will still look historically high on a real basis. And in that environment, you can see the 2-year somewhere around 2 3/4 to 3%, and the 10-year 3.25 to 3.5%. So 3s maybe not quite down to the 3% across the board when recession was a much higher probability.
Year end or year end next year?
No, I think once the Fed starts cutting rates with the money that's going to come into the market, it's going to happen this year.
Bob, this was fun. Economic Nirvana with
Happy
Bob
to be
Michael
here.
of JP Morgan Asset Management and a whole lot more. Just a little sprinkle of Liverpool for the Liverpool fans out there. Bramo, we're going back to 3. Going back to 3, not quite right the way through the curve, but getting close.
Bond scarcity. When was the last time that we
Yeah,
heard
that's
that?
shocking, right?
The idea that everyone was worried about supply, it's the opposite issue. Everyone wants to get in, and there just isn't enough of it. To me, that really is a massive takeaway.
And that is a non-consensus contrarian call, I would say, based on what we've heard over the last 4 months.
Yeah, but a lot of people are going into credit, so they're buying it whether or not
Yeah.
they know why.
Yep. Coming up in the next hour, Wally Adeyemo, the Deputy Treasury Secretary, Peter Chair of Academy Securities, Tiffany Wilding of PIMCO, and Ellen Wald of the Atlantic Council. The third hour of Bloomberg Surveillance up next.
Rates right now are coming down. The only question is when, and I do believe that it's going to be pushed out further.
We are pushing back against the market's pricing swift, immediate rate cuts starting in the first quarter.
There is this very substantial disinflationary process in place. It's just a question of whether or not you get an uptick over the next several months.
A higher volatility backdrop, both in terms of the macro conditions, including inflation, and the market, I think should be part of the assumption.
People still worry about inflation, and there's just not a lot of data to support the idea that there is any.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Let's get you to the weekend. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance alongside Lisa Abramowicz together with Annmarie Hordern, and I'm Jonathan Ferro. Your equity market totally unchanged on the S&P 500. What a difference a few months makes for the equity market. 6-day winning streak on the S&P 500. All-time high every single day at the close this week so far in the bond market. Yields were at 5%. Only back in October, right now on a 10-year 4.12, on a 2-year 4.32. The sentiment shift, amazing. Bob Michael, JP Morgan Asset Management, there's not enough bonds.
This comes after last year when he was expecting recession. Now we're in this sort of Goldilocks moment, this economic nirvana, as he called it. Look, everyone's done a 180, or a lot of people have. A year ago, people were talking about the impossibility of a soft landing. Dream on. And now people are saying, not only is it a soft landing, this is a no landing with disinflation and some cherries on top. I mean, at a certain point, you have to wonder how much more optimistic can people get.
That phrase, economic nirvana, we did not hear that phrase 12 months ago. It's all you hear at the moment. In about 29 minutes, 28 minutes or so, another read on US inflation just around the corner. Anne-Marie, that's one to watch going into the Fed next week.
Absolutely, especially when you have the polls continuously show that the data is not hitting how people feel about their pricing power when they still go to the grocery stores. One thing that is helping the administration, and Amos Hochstein was very proud of this yesterday, and we're going to speak to another U.S. official, is gasoline prices coming down. But will all of this be enough to change the perception of voters when it comes to November?
The whole idea of core PCE, the deflator figure that the Fed has been looking for, what do they need for an all clear? Right? How do they know that we're not going to get some sort of 1967, 1968 type of appearance of a soft landing with a resurgence on top? Not to be gloomy, but I do wonder, how do they sort of understand where the trajectories are going at a time where people are still spending on LVMH handbags and champagne?
It's not out of character at all. Don't worry, to be gloomy. Let's pick up on what Bob said. Bob thinks they should be high-fiving, doing victory laps at the FOMC meeting next week. When I hear a lot of that, doesn't that make you feel a little bit uncomfortable about how quickly the pendulum swung from one side to the other?
If they do that, I guarantee they will be pilloried. They're not going to do that. That would not be very popular. I will say that at this moment, though, there seems to be a real acceptance. The fact that Christine Lagarde did not push against the market pricing the same way that Jay Powell did in December. He also did not push back. They're not even worried about financial conditions anymore at a time when Bob Michael's sitting there saying that you can get credit if you easily anywhere, and that no one will default. I mean, he was talking a little bit tongue-in-cheek, but it gives you a sense of how much things have shifted.
That's why, or at least part of the reason, stocks are close to all-time highs this morning. Equity futures on the S&P 500 negative here by almost 0.1%, but coming off the back of the longest daily winning streak of the year so far. Longest winning streak, actually, going back to mid-December on the S&P 500, 6 days of it, down by not even 0.1%. Yields higher by, let's call it half a basis point on a 10-year 4.12.39. Coming up this hour on the programme, US Deputy Treasury Secretary Wally Adeyemo on the state of the economy. PIMCO's Tiffany Wilding reacting to today's inflation data and what it means for the Fed. And we'll touch base with Ellen Wald at the Atlantic Council on the politically charged EV debate and a little bit, Annmarie, on what's happening with LNG exports in this country.
Absolutely. There's a review the administration put out, and they're basically kicking the can down the road for these new LNG exports. And this is very political. Within the administration, there's individuals like Podesta, Granholm, who wanted the climate side to win. And then you have the national security concerns of individuals like Jake Sullivan. Amos Hochstein with us yesterday. Biden made a pledge to the Europeans that we will supply LNG, given the fact that you can no longer get that from Russia. Yes, this is not going to impact LNG leaving the United States today, but it sends a different sentiment to that market.
We begin with our top story this morning. The Biden administration appearing to declare victory on inflation.
We have seen some turnaround in sentiment in recent months. The University of Michigan Consumer Sentiment Index has moved up quite a lot. Inflation is now near term at close to the lowest levels we've seen in that survey. So I think Americans do believe inflation's under control.
Secretary Yellen making the case for a soft landing as fourth quarter GDP tops estimates and inflation continues to cool. I'm pleased to say, joining us on this programme exclusively, the US Deputy Treasury Secretary Wally Adeyemo. Deputy Treasury Secretary, wonderful to catch up with you again, sir, and to have a longer conversation about the US economy. Was that a declaration of victory on inflation yesterday?
So I was listening to the show before I came on, and you talked about all the people who have changed their mind. The truth is Secretary Yellen's been consistent. If you go back a year ago, she made very clear that we could grow the economy, bring down inflation, and keep a tight labor market, and that's exactly what we're doing. What she was saying yesterday was that we have seen progress made in terms of making sure that the middle class has more money to spend at the end of the month because gas prices are down $1.90. We know that there's more that we need to do in terms of trying to make sure that we put more money in the pockets of the middle class in America, and that's exactly what the President and Secretary are committed to doing. We're not declaring victory, rather we're saying we've made progress, and we're going to continue to make that progress going forward.
Deputy Secretary, why do you think there is such a huge gap between the sentiment and the economic indicators that seem to be making a really positive case for the economy?
I think the most important thing we have to continue to remember, and I just came back from a trip literally around the world, is that people are still impacted by the pandemic and the ways that it impacted their lives. But the thing we have going for us in the United States is that because of the work that our businesses have done, the American people have done, we're better positioned as an economy to deal with that. You think about the investments we made in things like the Advanced Child Tax Credit, which gave American families tax relief in the midst of the pandemic, and the relief that we gave to small businesses. And today we've seen 16 million applications for new small businesses in America. We're seeing progress, but what I know that has happened to the American people, but people around the world, is that the pandemic had an impact that has, in lots of ways, still continuing. But our economy is better positioned today than any economy of a major country around the world because of the decisions and choices the President and the Secretary have made. And our goal is to make sure that we continue from that position of strength to invest in the American economy.
Deputy Secretary, you're talking about getting more dollars in people's pockets, and we heard Janet Yellen, Treasury Secretary, yesterday talking about the potential for prolonging some of the tax cuts for people making less than $400,000 a year. How concerned are you that getting additional dollars in people's pockets will just fuel another round of inflation, which really gave people a lot of the negativity to start with?
I think the most important thing that we should look at is one of the biggest drivers of the inflationary pressures we saw in our economy was on the supply side. Supply chains were snarled, and you've seen a huge decrease in supply chain challenges in the economy. Energy is a great place to start. Just look at what we've seen in terms of the $1.90 reduction in the cost of gas. But throughout our supply chains, we've seen them improve to put us in a better position to meet the demand in the economy. And it's important to remember what the Secretary said. For the middle class, we're not going to increase their taxes. We're going to look for ways to provide relief to families, but we're also going to look to modestly increase taxes on the wealthy, on large corporations, because the Secretary and the President believe that over the medium term, we need to make sure that we have a fiscally sustainable outlook, which is very different than the last administration.
Well, you just got back from Japan, and I understand that CFIUS is still under review for Japan's takeover of U.S. Steel. We have the Prime Minister of Japan joining U.S. for a state dinner upcoming in April. Will we get a decision on this soon?
So as you know, we don't talk about any CFIUS cases if they exist or if they don't publicly. It's a private matter if there's a CFIUS case. What I can say is that CFIUS is a process that's been set up to look at national security risk and make sure that we in the United States, as we support foreign direct investment in the United States, we're also very mindful of the national security risk that some foreign direct investment presents. Stepping away from a specific case, one of the things that we believe deeply in is the importance of a strong U.S. steel industry. That's why we've made investments like the Inflation Reduction Act and the investments that we've made in rebuilding our infrastructure. And ultimately what we want to see is more companies like U.S. Steel in the United States that have union workers that are paid a good living wage. And that's exactly why we're making the investments we're making in the U.S. economy today.
But I'm looking at your readout, and it says the Deputy Secretary thanked his government counterparts for Japan's leadership. How is this a national security concern when it's one of the United States' strongest allies in the Asia Pacific?
So as I said, I'm not able to talk about whether there is a case or isn't there a case when it comes to CFIUS. The CFIUS process is one that we'll work through and take some time, and I expect that any CFIUS case that comes through will be treated in a manner that's consistent with the law. And ultimately, Congress passed a law that gave CFIUS certain authorities, and we plan to do our jobs in terms of reviewing the national security risk of any transaction that comes before CFIUS.
One of the policies you were discussing, of course, in Japan was the future of what is going on with Russia's invasion of Ukraine. Where are you in the status of talks with your partners about Russia's assets? Do you see a legal path forward with Russia's stranded assets to give them to Ukraine?
So, Annmarie, as you mentioned, one of the topics of conversation amongst the G7 and our coalition more broadly is how we make sure that Russia compensates Ukraine for the damage they've done to their economy. Our leaders at the beginning of the war immobilized Russia's sovereign assets that were held in our countries so Putin couldn't use them to fund his illegal war. Now they've said very clearly that Putin is not getting back those assets until he pays for the damage that's been done in Ukraine. And they've asked us, experts amongst the G7, to think about what we can do to try and compensate the Ukrainians for the damage that's been done. In Europe, they're talking about things like windfall profit taxes. We're debating a number of other ideas, with the idea being that ultimately we need to make sure that Russia is the one that pays to help rebuild Ukraine in order to make sure they have a thriving economy as well as a thriving democracy.
Deputy Secretary, appreciate your time this morning. I just wanted to squeeze in one further question, actually about trade. The former president is on the campaign trail, talking about the potential of a blanket 10% tariffs on imports into the United States. This administration has maintained tariffs on China from the previous administration. What is your position on that now?
So I think that a blanket 10% tariff that isn't well targeted would hurt the American people. And what we've done, instead of looking to simply do blanket tariffs, is try to work with our allies and partners to hold China accountable for the things that they are doing that violate trade rules going forward. Because ultimately what we know is that the best way to make sure that China lives by the rules of the road that we've all set is by doing that with our allies and partners rather than taking a go-it-alone approach. And that's exactly what the president's going to continue to do.
Do you think that US car manufacturers can compete with Chinese automakers without those tariffs?
I think the US car manufacturers can compete with anyone in the world if they're playing on a level playing field. And the problem today for them is that in China, there are subsidies that are being given to not only car companies, but throughout the ecosystem that are making it possible to produce cars that are loss leaders. And ultimately, the reason that in the United States, but also in Europe, people are concerned about Chinese vehicles flooding the market is because they're being produced in ways that violate basic trade rules. And it's why we're looking at our options here. But I know that Europe is also looking at their options to ensure that we don't end up in a place where Chinese overcapacity floods our markets.
What do those options look like, sir?
Well, I'm not going to get into them with you here, but we're having serious conversations with our allies and partners to ensure that we're in a position to make sure that our companies are able to compete on a level playing field.
That's why we do those interviews, Wally. We try and make it happen. Wally, appreciate your time. Wally Adeyemo there, the US Deputy Treasury Secretary on the latest. Tell you what, that final point, this is going to be a big issue on the campaign trail. Can automakers in this country compete? Yes, if there's a level playing field, but let's face it, there isn't one. So what can they do? What are the options?
And this is going to be really ultimately what it comes down to, because right now, if you talk to anyone in the industry, there is no way they can compete
if there are tariffs lifted or if some of the Chinese auto manufacturers are allowed to sell their cars in the United States.
Let's continue this conversation. Let's also get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. The Biden administration has halted the approval of new licenses to export liquefied natural gas. The U.S. Energy Department will study its effects on climate and the economy, according to a White House statement. The pause could potentially impact more than a dozen proposals now awaiting review at the agency. Senior officials have not put a firm timeline on the process. Blackstone is out to direct lenders for help financing its $2.3 billion acquisition of the online pet care company Rover Group. The firm saw about $250 million of private debt that would pay interest of about 475 basis points over the secured overnight financing rate. If successful, the borrowing would mark one of the cheapest private credit deals on record. And LVMH rallying after posting results that beat estimates. The luxury giant saw 10% growth in revenue in the last quarter, proving resilient amid a slowdown in the wider sector. Shares rose the most in almost 4 years as its billionaire CEO said he's, quote, very confident for this year. That's your Bloomberg Brief. John?
Yahira, thank you very much. Coming up on this program, up next, the rush into bonds.
Between Treasury supply and corporate supply, I'm worried there's simply not enough.
There's simply not enough bonds. That conversation up next. Live from New York City, you're watching Bloomberg Surveillance. A little more than 1 hour away from the opening bell in New York City. Equity futures on the S&P 500 look like this. We're negative by 0.08%. Bonds are totally unchanged in fixed income in the Treasury market, 411.81 on a US 10-year. Under surveillance this morning, the rush into bonds.
Between Treasury supply and corporate supply, I'm worried there's simply not enough. I've not had a single conversation over the last couple quarters with the client who said, oh, get me out of bonds. Every single one is saying, how do I get in?
Compare and contrast that with this from Peter Cheer of Academy Securities. I remain convinced that none of the issues that made markets wonder who will ever buy treasuries again have been resolved and are likely to push longer yields higher. That is why I'm thinking that a 4.3% 10-year, which seemed bold at 3.8%, seems insufficient. Peter Cheer, I'm pleased to say, joins us now. Pete, good morning.
Morning.
Compare and contrast your thoughts with what we heard from Bob Michael 30 minutes ago.
You know, I trade like much more as a contrarian style. So when we were at 450, we like 380. We got down there. We actually got below that. But I think some of the problems that were there back in the fall that were pushing yields higher are still there. I think it's going to be much more this time, again, about risk premium, term premium. I think 2s, 10s goes back to flat and maybe actually positive sloping. And that's what's going to put pressure on 5-year, 10-year, and 30-year bonds.
This is something that people are watching at a time when it seems like the enthusiasm just can't really be beaten out. What do you make of that? I mean, how do you basically say that the mood can shift that quickly if the data keeps confirming it?
One, go back when every single day we were looking at Chinese tick data. No one looks at Chinese tick data, and it continues to come down. So why did we stop looking at that? Nothing about the deficit increasing has really gone away. The cost of funds that it's going to cost, the amount that's going to be spent on interest is still going up. So all those things are still there. People just forgot about it. Remember, we were watching every auction with trepidation. Ooh, is this going to be a good auction or not? Now we're going into one no one cares. And to me, as a contrarian, right, when everyone's worried, people...
I know someone. Bramo.
Bramo
still cares.
They've been messy, 5-year and 7-year.
Yeah, so I would not be surprised to see a little bit nastiness on the new 10s and 30s when they come out in February, and that could be maybe what triggers, oh, shoot, we got carried away with where we are in yields. And the front end is definitely getting controlled by the Fed, but I think the long end is going to be risk premium, fears, deficits, etc.
This is Treasuries. You don't have this view on credit, do you? It's quite different.
No, I really like corporate credit. One, I think they did such a good job managing their interest profile, issuing longer dated bonds. And I really have been encouraging clients, especially in the 5-year and in, to be heavily overweight. If you manage a bond portfolio, say, against the ag index or a broad index, I want you to be heavily overweight corporates. I think from a governance standpoint, from all sorts of perspectives, you're still getting paid almost free money to own some of these really high quality corporates in a world where the U.S. can't seem to get its act together on deficit, where people talk much more cavalierly about not paying debt on time. They'll ultimately pay it, but why bother with that when you can buy commercial paper, other products, and get a spread to treasuries, and I think actually have better governance and feel safer at night.
Let's take a step back. Bob Michael was talking about how if the Fed cuts rates, that will help the deficit problem because suddenly interest expense will come down and that everything will be back to that economic nirvana that we keep talking about. How concerned are you that they cannot do that? Because the more that we're talking about rate cuts, the more longer-term inflation expectations just creep up just a little bit.
I'm fairly concerned, but one, even on that, it takes a long time to move the average coupon on the U.S. Treasury debt, right? So much of it's long dated. So when I got bullish, when everyone was scared at 5%, part of it was, listen, it's going to take time for this to creep in, right? It's a lot of the debt's longer. The average maturity, I think, is close to 6 or 7 years. So it doesn't rise overnight. Similarly, okay, now even if we get back to 4% on Fed funds, that's still much higher than the current average coupon. So it will creep in. I think that creep is coming over time. We get fixated on what current rates are. You got to look at the average coupon, how long that takes to bleed in. And that's where we're headed.
Let's talk about the nature of Academy Securities. We do this often. You've got all this military intelligence there, generals sitting alongside you. Can you lean on some of that for us now? We're facing some real risk abroad, Middle East, in Ukraine, and I think there's some comfort with it. And the comfort with it comes from about looking at the commodity market and seeing crude in the 70s and not rallying hard, and assuming that this isn't going to touch us, this is not a big deal in US-based capital markets. Do you share that view, given what you hear every single day?
So let's run through it quickly. So we've got the 18 retired generals and admirals. I would say Russia, Ukraine, we're leaning towards that there might be some sort of a truce or something this summer. I actually think that's going to be inflationary. I think that's what people are missing. A year and a half ago, it might have been deflationary as Russia was going to sell in. Now you're going to have to really build up the infrastructure there. The one thing that I think doesn't get talked enough about in the U.S. is Europe is getting very concerned about the forced migration issue. And you're going to have people potentially putting their kids into school 3 years in a row in a foreign country. Are they ever going to go back to Ukraine? So I think there's a bigger urgency in Europe to get this resolved. So we think that happens. I think the Middle East is going to drag on. It's ugly. What to me is the real tell is Iran is selling about 3.5 million barrels of oil a day, well above what the sanction levels. I think we've been turning a blind eye to that, and because it does keep oil prices down globally. If something happens that we are really forced to engage Iran directly and cut back on their production, that to me would be a price shock. And then the final thing, and we've been deciding a lot, what's hedged, what's not hedged. I think the flight to safety will not work. So we've been working with clients, and the natural reaction traditionally is geopolitical event, bond yields go lower. I do not think that will happen this time, maybe at the front end, but not at the long end. And partly because I think everyone's very quickly saying, oh my gosh, geopolitical event, commodity prices probably going higher. Deglobalization with China, increasing with every one of those. And finally, people are starting to realize war is going to be deficit spending. So I just think any sort of geopolitical event, we might get a small rally in treasuries. I would want to sell that because that, I think, pushes us above 450 when people realize the flight to safety is not the way to hedge this. I think you're supposed to be long commodities and commodity producers. That's my favorite part of the market right now.
When you look at inflation, you talk about the University of Consumer Confidence, and you say you haven't been able to figure out the value of the data as a reliable predictor of anything. We just played a soundbite of the Treasury Secretary yesterday talking about it. The White House has flooded our inboxes, telling people to talk about it. What do you make of it?
So maybe I'm a bit biased. I did work with Bob Janjua for a long time, and he used to be classic. He would put consumer confidence, and it was con and capital letters on both. So con. And I find it tends to, fluctuate with oil prices. It fluctuates with stock market. They're still telephoning people. The whole thing just seems somewhat bizarre way to calculate it. People know the answers. And the only thing I find ever interesting is how quickly because you can get it by party registration, how much that deviates and changes on a dime when one party's in power or not. So to me, it's kind of fun and games, but I don't trust it.
So Democrats feel better, but Republicans don't.
Correct. But when Trump was in charge, it was vice versa. So it's always that way. So I find the data a little bit dubious. It's kind of fun and interesting, something to do on Friday mornings when it comes out, but I'm not paying much attention to it.
Yeah, welcome to our life.
I think it's fun. I want to be part of the cause for you, Mitch. I'm desperate to be part of the cause. I want someone to call me and actually go through the questions and say, where do you think inflation is going to be in?
And you're going to say 25%.
1 to 5 years. And then I'm going to see what they do with the data.
Yeah, right. And again, I'm not sure how many people are really thinking about these expectations, how it all comes about. So I don't find it. I know the Fed does like these inflation expectations, and they rely heavily on the trend in expectation. I just don't think you go back even the last few years. They haven't done anything right, really. They haven't been horribly wrong. It's just data.
Peter Cheer of Academy. Pete, it's good to catch up, buddy, as always. Peter Cheer there of Academy Securities. Coming up next on the programme, we've got breaking economic data, personal income and spending, and core PCE deflator. All that data coming up. Mike McKee's going to break it down. We'll get the reaction from PIMCO's Tiffany Wilding. That's all coming up next. From New York City this morning, good morning. The last big batch of economic data going into the Federal Reserve meeting next week. Equity futures going into it. The scores look like this. On the S&P 500, negative by 0.1%. On the Nasdaq 100, we're down by 0.4%. In the bond market, on a 2-year yield, shaping up as follows. On a 10-year, a 30-year, yield higher by a single basis point on a 2-year, 430. 77, 430, 35. On a 10-year, 411. Yields lower there by almost a single basis point. The economic data in America has dropped. Mike McKee around the table to break it down. Morning, Mike.
Good morning, John. Check the March Fed Funds futures because we just got a 2 handle on the PCE core for the year. 2.9% comes in up 0.2 on the month, rounds to 2.9. First time since before the pandemic that we have had PCE core inflation that low. PCE headline 2.6, also a 0.2 gain during the month. That's the same as the month before. Personal income comes in up 0.3 for the month. That's a little bit lower than last month. And personal spending, a strong 0.7%. The forecast was for 0.5%. So we got some real strength in personal spending. That's not really a surprise because we saw the retail sales numbers, but it does suggest that we have fairly strong services spending as well. So this will help ignite the debate again about how soon the Fed starts to cut rates.
No big moves in this market. I can tell you we're pulling back just a touch on the S&P, down by about 0.2%. If you check out the bond market, yields were a little bit higher at the front end, up another couple of basis points, up 3 basis points on a 2-year, 4.33 on a 10-year, up a single basis point, 4.13 in the FX market. The euro basically where it was before the data at 108.72. Mike McKee will catch up with Tiffany Wilding in just a moment. And a big focus for Tiffany and the team over at PIMCO, and others too, is this spread that seems to be emerging between what you get out of PCE and what you get from CPI. Can you walk us through both and talk to us about what this might mean for the Fed next week?
Well, it's an interesting thing because the public tends to focus on CPI. The Fed's official target is PCE. Fed likes PCE better as a measure of overall cost changes. And there are some things in there that are different from the CPI, particularly housing, much lower weight in the PCE, and also some in the healthcare areas that comes in different ways. So you get generally about a 4 to 5 basis point spread between the two. And that has pretty much always been the case. But when the Fed says we want 2% inflation, they're talking about 2% that we're getting today with the PCE.
Bob Michael was on the programme a little bit earlier. You asked us to ask him what he should ask, or what you should ask, rather. He talked about QT. QT was the focus for him, not rate cuts. Do you think we get some clarity on that?
Not a lot. But what I think they may say is that we've begun to discuss it. They need to, because they're getting to the point now where we're getting into that gray area of where ample is ample enough in terms of reserves. And we're seeing the reverse repo sort of fade away at this point. And so they're going to have to make a change at some point. And the question is, how do they make it? Do they taper? And that's the kind of thing they're going to discuss for a couple of meetings. So if they say they've discussed it, then that puts a clock on it. And that will be interesting for the markets.
Mike McKee, thank you, sir. Just to run through the markets, we'll go through stocks, bonds and foreign exchange. At least there are no big moves here on the S&P 500, down about 0.2% in the bond market. Checking out a 2-year, 10-year, 30-year Treasury shaping up as follows. Yields are higher by 2 basis points, 10-year 4.14, up by 4 on a 2-year 4.33.65. I know we've got to move higher on yields, Lisa, but nothing really in this data to change the conversation in a major way.
Basically, it's bang in line with expectations. The only surprise is that spending came in slightly above where people had expected, and it was revised upward in the prior month. So to me, that was notable because people keep spending at a time where people say that consumers are really driving some of the strength in the economy. How do we sort of depart these ideas or take apart these ideas of both more spending and less inflation? When does that sort of become incompatible.
And unemployment below 4%, but apparently not a reason to be hawkish anymore because you're not seeing wages run away.
So at what point is this a moment in time, to quote some of our guests, and not something that you could extrapolate out versus just basically the post-pandemic right-sizing that we're seeing just work through the system and create basically what we had before the pandemic?
What did Bob call it? Economic nirvana?
Yeah.
For now, at least.
Yeah.
Tiffany Wilding with us, PIMCO economist and managing director. Tiffany, we would love your reaction to the data. And if we can build on the conversation that Mike and I were having, I know that you've been focused on this in a big way, the difference between PCE and CPI. What's your read of things?
Yeah, well, maybe just to start off by talking to what you guys were just focused on. You know, I think that one of the key questions is, how much additional improvement, supply-side improvements, can we get? And this gets back to how much additional normalization post-pandemic should we expect? And where will the economy be? What is the underlying trend in inflation once all of those pandemic-related effects fade? And we don't know that yet. We can try to estimate it, but we're not really sure what it is. And we're still kind of waiting to see that. And actually, in our minds, that plus the fact that demand in the U.S. economy still looks pretty strong might be enough to keep the Fed on hold for a little bit longer than maybe the markets were pricing. And then there's the other issue of this core CPI versus PCE. As you guys suggested, the measures are calculated differently. CPI doesn't look as good. We're at 4% still on a year-over-year basis, even though we've gotten down into that 2-point-something range with PCE. There's a lot of non-market factors, non-market prices that go into the PCE, as Michael McKee sort of suggested. And those are the things that are kind of contributing to the good news. So the Fed's kind of just getting lucky, frankly, on the PCE. We think the optics of the CPI, plus the fact that demand just continues to look so strong, probably will keep the Fed on hold a little bit longer here.
Yeah, I got to say, I was talking to Joe Davis of Vanguard, and he was saying he's worried about this market, this economy, being something of a 1967 economy, or basically it looked like a soft landing. The Federal Reserve was able to cut rates, and then inflation picked back up again in a rapid way. What are you looking at to make sure that's not the case? What's the most accurate gauge?
Yeah, well, I mean, I think that's the thing, right? Like, you have to estimate it. You can't really observe it in some sense right now. And it gets down to how much inflationary pressures is a tight labor market producing. And as I said, because we've gotten a lot of tailwinds to inflation as a result of, these supply chain improvements, we're not really sure what that is. So the models, there's various models that have been devised since the pandemic to try to estimate this. When our look at all of them sort of suggests that inflation absent a weakening in the labor market maybe is running closer to 2.5 to 3 on an underlying basis, which obviously is above the Fed's target. So those have been the basis of our reasoning that you probably do need some more weakening in the labor market. You need growth to slow for the Fed to really get back to 2% in a sustainable way. And we're just not seeing growth really slowing that much.
But in December, Jay Powell didn't seem to push back against market pricing, didn't seem to push back against this idea, seemed to frankly embrace the idea of a soft landing. Why do you think that's going to change? And they're going to be less likely to cut rates in March, given that if you look at a year-over-year comp, at least in the past 6 months, you are seeing it back in that 2% range. And a lot of people are saying, you've got it. You could take a victory lap, as we were just hearing from Bob Michael.
Yeah, I mean, certainly their preferred inflation measure is definitely going to give them cover if they did want to if they did want to cut rates in March. We think it's going to be running at 2.7. They're going to be pretty sure it's running at 2.7, that February data, that we'll get right around that, a little after the meeting, but we'll probably know the details of it. So there definitely is cover for them to start to cut. And I think one of the questions here is, so we've done some historical analysis on central banks and when they tend to cut, and it basically suggests that central banks always tend to be too late, and they're not really cutting until their economies are already in recession and unemployment rates are up. So maybe knowing this kind of historical analysis, the Federal Reserve, instead of that kind of behavioral, historical way, they want to actually push against that and say, you know what, maybe we're going to get going now, but we're going to go really slowly. That's certainly possible that they could do that. And I think Waller suggested that kind of more recently. So we definitely wouldn't rule out March. It's a live meeting. I guess just for us, the balance of risks, still it's become more balanced, but maybe still is a little bit more on the side of inflation risks reaccelerating, which suggests to us that maybe a mid-year cut is more reasonable. And by the way, that's what we think is in line with the median for when we look at the summary of economic projections from Fed officials.
Tiffany, what's the consequences of easier financial conditions? And I ask this because that's ultimately why it matters, right? Is that if they cut, it could potentially ease financial conditions all the more with people pricing in another 8 rate cuts, which just seems to be the way that things go these days. So how much is that really contributing to your concern about inflation reaccelerating?
Yeah, I mean, so we have a housing shortage right now, and you have to, you have to keep in mind that higher interest rates, does result in both supply and demand within the housing market slowing, and we've seen that. We've seen housing market activity really collapse. So, I mean, one of the things is that as rates fall, you're going to see housing market activity reaccelerate, and that's going to provide a growth boost. And so the broader inflationary effects of that, I think you have to take those into account. We do think you're going to get some reacceleration. So that's why, even though the Fed, does want to start to ease, they do see inflation down. The way they do it is they're still going to have to try to manage financial conditions. So they probably are going to tell us when they start easing, it's going to be very slow, very methodical, right? And we don't want financial conditions to ease too much. But of course, the markets will extrapolate as they always do.
I don't want to make this too circular, but just to go into this a little bit more. So if the Fed doesn't ease or cut interest rates anytime soon and inflation keeps coming down. We had Matt Lazzetti at Deutsche Bank on with us recently, Tiffany, and he talked about that being passive tightening, just allowing real rates to increase. Is that offset by the broader easing of financial conditions that we've seen since October? Does one cancel out the other?
Well, I mean, so, if what is priced in to the bond market in terms of the path of the Fed funds rate, if that's not realized because the Fed's staying on hold longer, then that mechanically should tighten financial conditions. And I guess the question is, given how strong the economy looks, maybe financial conditions should be a little bit tighter. So, in our minds, that's a little bit of a reason to wait a little longer here. I mean, you don't want to get that premature reacceleration that could be inflationary.
Interesting. Tiffany, appreciate the update ahead of the Fed next week in reaction to that data, in response to the data just moments ago. Tiffany Wilding there of PIMCO. Just to get you up to speed on some of the price action going into the opening bell, about 50 minutes away. Equity futures on the S&P 500 shaping up as follows, with slightly negative by 0.05%. On the Nasdaq 100 down by about 1/3%. As if the data never really happened at the equity market. On the Russell, the small caps up by 0.5%. Yields did get a kick higher though, up by 4 basis points on a 2-year, 4.33 on a 10-year, up by 0.5 basis point to about 4.12. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. China's central bank has unveiled plans for targeted stimulus meant to guide money into specific sectors. The PBOC made the move after surprising investors this week with a bigger than expected cut to its reserve requirement ratio. Economists see the central bank following up by steering credit into select areas and making a handful of trims to the amount of cash banks must hold. And Salesforce is reportedly the latest tech firm planning to cut jobs. According to the Wall Street Journal, the company will lay off 700 employees, but is still looking to fill another 1,000 positions. Salesforce made more drastic cuts a year ago, reducing headcount by 8,000. The news comes as Google, Microsoft, and Amazon all announced layoffs in the tech industry this month. Liverpool manager Jurgen Klopp is stepping down. The football club chief said in an interview posted on X, he will leave the club at the end of the English Premier League season. Klopp has been at Liverpool since 2015, winning 6 trophies, including the coveted Champions League. He said he is, quote, running out of energy. And that's your Bloomberg Brief. John?
Yahara, thank you. Appreciate the update. Bramo on the phone right now, getting messages from home about Liverpool.
Yeah, just it's sad. He was a beast, evidently, and
you're forced to watch this every weekend, though.
I am, and forced to watch them win. And
forced. Mohamed Salah is amazing.
Learn to love it or not.
Excited to sit down and watch that.
I mean, it's exciting. I used to play soccer, and it was called soccer.
So did I.
I'm not
Forward
weighing in on
midfielder?
that.
I was
I'm not
forward.
going to weigh in on that this morning.
Left forward.
All right,
What
just
about
going
you?
to.
Well, to Bob Michael's point, I'm reading
Soccer.
now that the coach said he'll never manage a club in England other than Liverpool. However, he is still open to managing another team in the future.
Yeah, let's see if that's a national team. And that's what Bob Michael was talking about a little bit earlier. Coming up on this programme, less football, more on energy. The Biden administration keeping energy domestic.
It's an energy transition, and I believe that we've done that quite successfully and have allowed gasoline prices to come down.
A conversation just around the corner, live from New York City this morning. Good morning. Live from New York City, equities totally unchanged on the S&P 500, just turning a little bit positive in the last couple of moments, going into the opening bell in about 44 minutes. Under surveillance this morning, the Biden administration keeping energy domestic.
I believe that we've done that quite successfully and have allowed gasoline prices to come down, which has helped food prices to come down because we are a farm to truck to table, not a farm to table. And we've also at the same time been able to accelerate the transition.
Here's the latest this morning. As US oil production hits a record high, the Biden administration is halting new exports of liquefied natural gas, saying in a statement, quote, "This pause on new LNG approvals sees the climate crisis for what it is, the existential threat of our lifetime." Alan Wald of the Atlantic Council warning against plans to stifle the US LNG boom. Running in Barron's, quote, "The plan would at worst halt future LNG exports that can strengthen our domestic economy and help our allies in Europe and Asia. At best, it will add unnecessary delays to America's LNG export growth." Alan Wald, Senior Fellow at the Atlantic Council and author of Saudi Inc., joins us now for more. And we've got to talk about that and EVs as well. But let's start with the latest story this morning and the breaking news this Friday. What's your base case? You gave us your worst case, your best case. What's your base case?
I don't really think there is a base case. It's either they freeze all approvals, basically probably until the election, maybe until the next administration actually takes effect, or they continue to approve LNG export terminals. I mean, this is an impressively, amazingly growing industry. If you look at the upward trajectory of U.S. LNG exports from 2016, it has grown faster than any other country in the world. And we're one of the only countries that has more room for growth. If you look at Qatar, if you look at Australia, they're all leveling off. If the world needs more natural gas, we're the ones who are going to provide it.
Even with this move, though, Ellen, when you look at the market, the U.S. will still maintain the prime spot for LNG exports, right?
It will, but we do need to continue with that upward trajectory. We've got over there's $100 billion in investments that we're waiting in LNG export terminals that were waiting to be approved at the beginning of 2023. We could double our export capacity just in a few years with the projects that are already underway awaiting final approval. So this pause to me seems to be incredibly politically motivated as opposed to based on any kind of environmental or climate concerns. We know that LNG displaces coal. We saw that with Pakistan. As soon as spot prices for LNG went up because Europe was buying more, Pakistan reverted to coal. So if we want countries to burn natural gas, which is a cleaner burning fuel than coal, then we've got to be prepared to actually supply it.
It does feel very political. And this morning, Senator Joe Manchin is saying he wants a hearing on it. Senior administrative officials who briefed us on the decision said that they won't put a firm timeline. So is it your understanding that this is obviously just going to go past the election so the campaign could go out and talk about doing more for the climate and try to get environmental votes?
That's my sense, which seems a little bit odd considering they've already got plenty to stand on when it comes to the environmental picture. I mean, if you look at the timeline for approvals on these projects anyway, we're talking 330 days as an average. That's the longest time frame for approval that we've ever seen. Even the Obama administration only took 155 days to approve these export terminals. So it seems to me like it's really just coming at the specific behest of some climate activists, and whether or not this is really even going to impress anyone or impress any kind of environmental votes, it seems to me is a bit misguided.
And it's not necessarily just this issue. You were talking about how there's sort of a misguided type of policy mix from the administration when it comes to electric vehicles as well. And you were responding in part what we heard from Amos Hochstein. You wrote this: current policies are hurting demand for electric vehicles. Washington needs to unleash the power of the U.S. market by removing barriers to accessing capital, fast-tracking manufacturing, and promote domestic demand. Can you elaborate on how different what you think is necessary versus what is actually in place?
Yeah, so what we have this year coming into effect in 2024 is a provision of the Inflation Reduction Act that makes only certain electric vehicles that have certain battery components that are made in the U.S. eligible for the full federal tax credit, which is a fairly significant tax credit that could be very important for people when they're deciding whether to buy an EV. And only, I think, about 2 cars actually qualify for this. And that's because we don't really have a domestic lithium battery cell refining or production industry in the United States. All of that, or almost all of that, comes from China. We want to create this. We don't want to be buying Chinese products, and that's a very important thing to encourage. But by putting in place a regulation now that forces you to basically, it says you can't really buy these cars and get the full tax credit, but we don't have that industry yet. So in my mind, they're killing demand for EVs before the domestic lithium battery refining and production industry even got a chance to get started. They need to encourage demand for EVs, which will then encourage the creation of this domestic refining industry. But by killing this tax credit now, they're going to kill demand, and no one's going to even want to build an industry because there's no demand for EVs.
This raises a deeper question, Ellen, which is this whole question of what happens if BYD is able to sell their cars freely with no taxes in the U.S. Would that be good or bad for the industry? Yes, it would demolish the U.S. car companies, but it would actually maybe increase demand. What's your take on what kind of barriers there should be to level the playing field, as this administration says?
I think that there should be barriers to buying cars that rely entirely on lithium and battery components from countries like China that, have terrible environmental practices, basically use slave labor, and also dominate the lithium industry through very unfair trade practices. But we can't just assume that we can create our own non-China lithium production industry out of thin air. It has to be cultivated. And so in addition to having these tax credits available to spur demand, we've got to also encourage lithium refining in the United States. We need to make capital available for smaller businesses. We need to be able to fast track manufacturing for new innovative processes. If you look at the whole kind of ecosystem here, a lot of the innovation in battery technology actually comes from the US. It's just that China is doing all the grunt work.
Interesting.
So what we can do, though, is encourage that manufacturing to happen in the US where the innovation is also occurring.
And I just want to jump in quickly. In about 60 seconds, if I could get your view on this. Wally Adeyemo, the Deputy Treasury Secretary, was with us a little bit earlier on the programme, and we talked about options. How do they ensure that automakers in this country, Ford, GM, Stellantis, Tesla, can compete with Chinese manufacturers? Are we going down the road of much higher tariffs, and can they deliver those tariffs given how dependent we are on supply chains out of China?
Well, exactly. I think that we've got to kind of, you've got to kind of stop just putting tariffs on these products, and you've got to actually encourage us to have this domestic industry. You've got to make more capital available, more loans. There are all sorts of strings attached to getting these government loans and government funding to develop this lithium stuff in the U.S. Cut that red tape out so we can actually develop it so our cars can compete without the need for massive tariffs. Let's do that instead of just saying, oh, well, you only qualify for the full federal tax credit if your battery is made in the U.S. Oh, but by the way, we're making it really hard for you to actually make batteries in the U.S.
Ellen, appreciate your view on this subject. It's a subject we'll be talking about all year. Ellen Walder of the Atlantic Council. Ellen, thank you. AMH, big one for campaign season this year.
Absolutely. And there's a lot of hypocrisy in both these two stories. To Ellen's point, you cannot get those full tax credits if the batteries are not components made in the U.S. or allies. So basically, China. At the same time, this LNG move is a win for another adversary, Russia. So what is the administration doing? Are they leaning into climate, or do they care about national security?
Well, they've got to clarify the message going into the election season, that's for sure, because President Trump, former President Donald Trump, has his own views on this situation. Big week ahead for next week. Before we get to the weekend, one more trading day. I'll give you a flavour of Monday's show. Coming up on Monday, Dom Constam of Mizuho, Chris Harvey of Wells Fargo, PIMCO's Andrew Balls, and NYSE President Lynn Martin. All of that still to come next week, Bramo. Before we get to the weekend, we're looking ahead to the Federal Reserve.
Yeah, it's going to be a Fed meeting. It's also going to be a host of tech earnings, all of that coming out next week at a time where people are just really embracing economic nirvana fueled by an incredible tech boom that's going to keep the American exceptionalist dream continuing.
No snark there whatsoever. I'll say this, and I mean this. It's my favourite week for earnings, when tech earnings start to come through.
They come out after the bell.
Live from New York City. That's exactly why. That does it for us this morning. Thank you very much for being with us. Good morning. Enjoy your weekend.